To me, the overall story is still the same, which is we have a period of disinflation in front of us.
Inflation falling to target is currently underappreciated by markets.
Stocks have been relatively resilient in the face of the fact that data is consistent with stickier inflation.
There's really kind of an everything is awesome mentality permeating the market right now on hopes of this not only soft landing, but no landing.
Investors have been really underinvested, and now they're kind of holding their nose and having to play catch up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500 lower by 0.2%, kicking off the month of March with NYCB Kitchen Sink Volume 2. That stock is negative. It is down hard. We are plunging 29%. These are the issues, Bramo. Discovering material weakness, writing down the value of companies it acquired, and replacing leadership over at NYCB.
The kitchen sink for the first time was about loan loss reserves, and a lot of people were saying this is only because it crossed the $100 billion threshold of assets and had to withhold much more. This raises questions of whether it goes deeper than that, which to me is more concerning and maybe speaks to something broader about the risks of rates remaining higher for longer.
All the things you don't want to hear from a bank. Here's the quote related to internal loan review, Annmarie, resulting from ineffective oversight, risk assessment, and monitoring activities.
Yeah, this is concerning because everyone has come out and was talking about this as idiosyncratic just to this bank and not to other banks dealing with commercial real estate. Lisa, you bring up the point that potentially this shows that this goes deeper. You have to think Jay Powell is going to be on the Hill next week, Jonathan, talking to House members, talking to senators. He's going to get asked about what is going on in the banking industry and if there are wider concerns.
The word you used, I think you're going to hear a lot this morning, idiosyncratic. Let's go through it. NYCB's largest real estate exposure comes from about $37 billion in apartment loans. And here's the important piece, with almost half backed by rent-regulated complexes. That's the big issue for this name.
There is a very specific issue in New York State, New York City in particular, about how much people can charge for rent and then what that does to certain valuations, especially at a time where so many of the apartments are held by that. I will just say, taking a step back, right now, the markets don't care. They care about NYCB. They care about nothing else, because right now you're seeing new record highs. And this kind of thing is really being shrugged off to the extent that a year ago people would have said, oh, my God, the sky is falling. We better just hunker down and get rid of risk. You're not seeing that in the same way. And that tells you a very big message.
And not just new record highs in the equity market more broadly, by the way. JP Morgan closing yesterday at another all-time high. You take the month of February. This has been an issue for us since the end of January with this individual name. Regional bank index down about 3% last month. No drama there. We've seen much bigger moves than that. S&P 500 banks up close to 4% in the month of February.
At this point, people are looking for the bottom. They're not looking for another risk, another shoe to fall. And this is sort of the question that I have. Have we basically worried ourselves out? And now we don't have any worries left. And so people are just sort of throwing in the towel and saying, fine, I'll go with it. I'll buy. We'll have another net record high on the NASDAQ for the first time since 2021. OK. Are we getting to that point?
I have no doubt you'll find something to worry about in the next 60 seconds or so. And I'm sure you do. You have a list to work through for the next 3 hours or so. Equities right now on the S&P 500 look like this on the S&P. We are slightly negative. We're down by 0.14% on the S&P 500. NYCB getting hammered down 29%. Yield to lower by 2 basis points. The 10-year 422.48 in foreign exchange. Eurozone CPI. Upside surprise. Not the right kind of upside surprise. 108.13 on euro dollar. That currency pair positive by about 0.1%. Coming up this hour, Steve Weidiger City as March kicks off with US stocks at all-time highs. Chris Marinac of Janney Montgomery Scott as New York Community Bank plunges on newfound weakness. And Greg Valliere of AGF Investments as Biden and Trump offer 2 very different visions on the southern border. We begin with our top story this hour, leaving behind a February full of tech-fueled stock market records. Steve Weidiger City expecting the broader market to close the gap on big tech, saying this: the extreme divergence of large cap tech profits from other industries should diminish this year and next. We would not be surprised if Mag 7 EPS gains in 2024 were cut in half on strong investment spending and greater competition. Steve joins us now. And Steve, that's a lot to get through. Can we build on that just a little bit more? Well, you're expecting some of that gap to close.
If cut in half means 20 to 25% EPS gains, that's still substantial growth. You know, industries that are literally booming, and there's probably a very limited number that are doing that. Booms you worry about on the other side of those sorts of things. But they're not going from large gains to declines. They're going to a bit of a slowdown. And, again, look at Mag 7. There's probably 4 companies that are buying up every microchip that they possibly can to offer AI services. Now, there's an open question as to whether these services, again, are going to find demand in the economy from just about everywhere, that they're not going to compete with each other and that they're really going to all be able to boom together, or will they compete and they will narrow down profits? I think, again, we're not willing to give up diversification in portfolios, right, to just bet on that single trend. And so, again, a lot of other good things are happening in the economy. We're raising our economic forecasts, raising S&P EPS forecasts, and seeing industries that have been weak for the last year and a half bottom out and begin a recovery. They won't do as well as Mag 7 in terms of EPS gains, but hey, they're at a very different valuation.
You're clearly not bearish. You're overweight equities, small, mid-caps. Talk to us about the industries you like right now.
Well, again, you can get mid-cap growth companies in the United States for about the same valuation as European shares. Only the U.S. mid-caps have grown at about 11%. And Europe has grown at about 2%. I think we increasingly want to swerve towards healthcare, something that's been out of favor with the exception of GLP drugs. Equipment makers have had a historic growth rate of 9% dividend growth for 3 decades. They're trading 15% off of their highs. And again, a lot of people thinking that we'll never do anything in healthcare except lose weight, which I wish I could.
I will say that a lot of people are working on that. I'm curious about the idea that everyone seems to be shifting to this idea that earnings are coming better than expected. The U.S. economy is stronger than expected. Fiscal keeps on supporting everybody for the foreseeable future. So why is it that cash funds are on pace for another year of record inflows? People are talking about cash is trash. I don't think so. People love their cash funds and they are plowing more money into them.
So look, the reason why we're not more overweight equities is a great competition from yield. And so we want to participate in that. Our bond portfolios have a little bit below average duration. We expect, again, to earn that longer than the Fed will stay at 5.5%. But this is good competition. And look, we've been bullish for a while. We've seen increasing bullishness. We've seen new shorts being set in the equity market. Everybody is bearish in the bond market and extremely short the bond market. I think that there are some areas which have been so strong that we want to just start to ease back from them. When you've had 80% returns in software, for example, it just is time again to just start to shift to some of the other areas. But there's room for both stocks and bonds in portfolios right now.
This doesn't sound like a market that's been drained of liquidity. It sounds like an economy that is flush with liquidity. Why has the Fed been so ineffective at draining this market of liquidity?
Well, again, do you have to? Must we have a new recession, again, to stop this rapid inflation? I think we have another troubling inflation report. That's going to come in March for the month of February. It's going to be another reason for everyone to say, well, wait a second, maybe we're not on this disinflation trend. Maybe we're going to be stuck here with the Fed doing QT and 5.5% funds. That's possible over the short term. But the reality is, the good news has been we've been able, again, to get supply and demand to line up a lot more in a stable way without a massive surge in unemployment. Now, if we get too excited about that, there's going to be some problems.
You've upgraded growth. What do you see? What do you like? What's leading to that?
Well, I think, again, it's weaker pieces of the economy. We've had a hidden recession underneath the surface. If you're looking at Germany, if you're looking at Japan, if you're looking at China, if you're looking at manufacturing in the U.S., which is nobody would really look at, but the reality is it's contracted for the year behind us. Trade contracted 8% in the year through the third quarter of last year. And these weaker components, again, are moving into a more stable, growing place. Probably not going to be anything V-shaped, but it's those things along with large cap tech, with AI, which is in the boom.
There's been a big spread between manufacturing and services for quite a while, as you indicated, over the last year, 2 years. Manufacturing started to come up to services. Is that how you expect that story to complete?
But remember, it will come with a very different labor market outcome. services, labor intensive, manufacturing automated, right? So the headcount differences are going to be really, really substantial. The services industries can't keep adding 200,000 jobs per month just in those industries, right? So you've seen a halving in employment growth from where we were 2 years ago, when services just turned right back on like a light switch. Again, hospitality, airlines, travel, all of these things, incredibly labor intensive, and we had massive job losses there to recover. But now we're at the point where I think it'll slow down. And it didn't in the month of January. It was 353,000 jobs in January, but we saw seasonal distortions in employment, inflation, retail sales, all of these things in different directions. It's going to take a while for the market to sort it out. I think we'll be a little more worried before we start to really come to grips again.
John mentioned your upgrade of U.S. GDP. Mohamed El-Arian recently in Project Syndicate was talking about what happens in the United States matters to the rest of the world, doesn't stay in the United States. Do you foresee then U.S. growth, if you see it picking up, helping the rest of the world?
It is, but it's challenging at the same time because, again, the amount of time that we spent with restrictive monetary policy is still going to be a bit longer. We haven't changed our mid-year estimate really, but again, confidence that we're going to have easing, the communication of easing through markets, right? We could set that back some. So the dollar has been stronger. Now that both helps and that hurts. Yields have risen this year, right, at the long end of the curve and across most of the curve. So those are modest challenges, while some of the things are really helping. Consumer demand has not collapsed, and producers have been underwhelming, and they've been really short in terms of meeting demand.
Hey, Steve, it's good to see you. Always great to catch up. Thank you, sir. Steve Whiting there of Citi. Bramo looking for one, maybe more than one, ugly inflation report in the next few months.
That everyone can then just look past because it's really going to be this ongoing disinflation. I'm really interested in what a lot of people are saying, not just Steve, about it's not going to be an even ride with AI adoption. And I think my favorite story from this week was Teleperformance, which is this French call center. And basically their shares absolutely plunged because Klarna said that basically they could respond to all their calls using AI. And that was wiping out the entire industry of people who would call you up. I mean, these are like the little pockets of distress that I find fascinating in this transition.
Is this on the list of things to worry about?
Yes.
Is this it? French call centres?
Absolutely.
Is that where we're at?
Well, if you think about it, how many businesses like that will be rendered completely obsolete that have not been priced yet for that type of outcome?
The Uber bear on Wall Street is now sort of like holding on to French call centres.
100%.
The bearish thesis.
It's going to be my clarion call.
Bramo, never change. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The BOJ governor is keeping the markets guessing over the timing of the central bank's widely expected rate hike. Kazuo Ueda told reporters at the G20 central bankers meeting in Brazil that the price target is not yet in sight. Now, his comments did appear to pour cold water on the earlier move this month. Economists, though, for their part, are still anticipating a near-term hike in March or April. The last time the BOJ raised rates was 2007. SNB President Thomas Jordan is stepping down. It was a surprise announcement. It's going to happen at the end of September. He had been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis. He removed the cap on the franc in 2015 and adopted the world's lowest interest rate. And dealt with that whole banking crisis thing. Don't miss Bloomberg's interview with Thomas Jordan. That's going to be later today. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw support for its Facebook News tab in the countries from April. Publishers with existing agreements with the company will still be able to post content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for content, but Meta says demand for the service has declined. That's your Bloomberg Brief. John.
Danny, thank you. I can't believe it's been a decade on the job for Thomas Jordan. I interviewed him shortly after he got it. It's amazing how quickly time flies, Lisa.
I saw that and I thought, didn't he just get there?
I know.
It's wild.
Ridiculous. I just want to talk about Apple briefly. Removed from the conviction list at Goldman. The stock is down by about 1%. We'll pick up on that later. Up next on the programme, New York Community Bank shares plunging once again.
500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment.
That conversation is coming up next, live from New York City this morning. Good morning.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
Four months of gains on the S&P 500. Live from New York City this morning. March 1, we're down about 0.1% on the S&P. Under surveillance this morning, New York Community Bank shares plunging once again.
For investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. Those banks grew really quickly. And so as we're out on the road talking to investors, we're doing conferences, they're nervous about growth in banks too quickly. 500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment.
It's the latest this morning. New York Community Bank shares plummeting. The company announcing, quote, material weaknesses in its loan review process. The bank quickly swapping CEOs and warning investors it expects to miss a deadline for filing an annual report as it shores up controls. Chris Marinac of Janney Montgomery Scott saying this: director changes are part of the early repairs at NYCB. Investors should be pleased to see swift action given what occurred a month ago. 2 directors have resigned. We see this as a healthy change that should build confidence. Chris, I'm pleased to say, joins us right now. So, Chris, I assume you believe this stock should be up this morning and not down 30%. Is that right?
That is right, or at least trading flat, John. I don't see any reason to be haircutting the stock. Tangible book value only changed by 3 pennies, given the fourth quarter changes filed last night. Very minor.
Why are you so confident there aren't any more monsters underneath the bed at NYCB?
Well, I think the company's issues have to do with stress testing. The company has to stress test for higher interest rates. They're doing that. They increased reserves. I think there's more of that to go, but the company has the earnings to work through this. This is not an earnings issue for the company. The credit issue for the company is stress testing and not having done it sooner. And I think the prior management team, unfortunately, had to go. I think we had to have the change in management to have a confidence change. The largest individual shareholder is Sandro Danello. He's taking charge. He's making very swift changes. You have a few unhappy board members who have left, and that's fine. They should change too. I think this is all healthy to get the company where it needs to go. They're now $115 billion. They have to be part of the new world order that is a regional bank under new guidelines. And yes, the regulatory world is changing quickly, but you have to adapt and you can't sit still.
You said there are a couple of unhappy board members, and I'm glad you brought that up because that raised a red flag in my view. The director of the board, Hanif Daya, resigned, and in the resignation letter, he said that he didn't support Sandra Danello's appointment to CEO. Why?
He's been with the bank since 2007. I think he did not want to see the CEO change. I think he decided to vote with Tom Cangemi. That's his prerogative. I think you're going to see the company move forward with another director and frankly continue to make the changes very quickly. You have one quarterback at the company. You can't have 2. So you have to take QB number 1 and run with him and make these changes and move forward. I think the story is really going to transition to recognizing credit risk and frankly fast-tracking a lot of the changes to diversify the portfolio. They've had too many multifamily loans and too much real estate. They'll change that. They'll be a much more balanced company. And frankly, they'll make more money, which will create book value growth, which will get the stock price moving again. That's what investors are overlooking. But that's a short-term reaction. I think that will change.
The vast majority of people who are waking up right now in markets probably don't care about New York Community Bank Corp in terms of that particular company, but they do care if this is a harbinger of more weakness to come. If this means that yields remaining higher for longer is creating some real cracks on the balance sheets of banks that have already been punished but can't seem to climb out of it. How would you argue that this is truly idiosyncratic when this is not just a regulatory capital issue?
So every bank has credit risk. And I think if you look at the 10K filings we've seen this week and last week, we are seeing increases in the criticized assets. Not as much non-accrual and non-performing, but really criticized. Again, back to the stress testing issue. Banks are recognizing the risk. I think what investors don't see is that leverage is 60% today instead of 95% in 2008 and 9. It's a material difference. So you're not going to lose money at New York Community like you would have 15 years ago because leverage was much higher. You'll have some losses. You'll have some need to build reserves. They've done a big piece of that already. I think the whole industry is going to continue to march forward and be a lot more profitable than folks understand. The other point I'd make is that most banks are asset sensitive, which means that higher interest rates for longer actually benefits than interest margin. You'll see in most 10Ks that companies actually see an increase to earnings if interest rates are high. So in a lot of respects, the Fed cutting rates too quickly is not a great thing for the industry. I think it is a perception issue we have to overcome.
I have to wonder, though, when this thesis comes true, right? Because right now we're looking at, yes, higher yields, but an inverted yield curve, which makes it really challenging. As we heard from Hope Dymchowski, we also are seeing some real concerns about loans that are not getting liquidated because there just isn't a market for them. When does the page change for banks that otherwise are pretty challenged when it comes to profitability right now?
I think the banks are in much better shape than folks realize. I actually think there's enormous liquidity out there, whether it's private credit, other investors, other banks who will buy the loans. I actually think it's much better than perceived. The challenge banks have on either selling loans or liquidating other assets is that they don't want to take big haircuts today. They'd like to let time pass and work that through. Sometimes they're able to do that. That's where reserves and capital come in. Other times they have to take action. I think in NYCB's case, you're going to see them continue to take action very swiftly. We've seen it with the changes here. I think the 10K delay will be resolved within 14 days. A lot of that are changes that have to happen under GAAP accounting. And honestly, we've seen other banks with internal controls that are large companies like JP Morgan and Wells Fargo. They've made their changes and moved forward.
A year ago, SVB's collapse, ultimately, the underlying issue was also higher interest rates. You're talking about the New York Community Bank, poor stress testing on higher interest rates. Who else is having poor stress testing issues right now? What other banks when it comes to high interest rates? Or should we just expect this to happen every few months?
Well, I think NYCB is unique in terms of having crossed over $100 billion with an FDIC transaction, not being fully prepared to do the stress testing this year. That, I think, is idiosyncratic. I think the rest of the industry is all over this. I think what you're going to see is that the SVB issue was about poor liquidity management, top-heavy securities that were underwater, and then, frankly, deposits that were out of whack because they had large venture capital deposits that all ran. Those big concentrated deposits are all gone because they largely were at SVB, First Republic, and its Signature. So the industry is in much better position from an uninsured deposit standpoint. And NYCB has had excellent deposit flows through the past month. That's really what investors should focus on. The deposits have been stable. The company's going to make money this quarter. It's just unfortunate that they have to make these management and board changes now. But again, it's going to be for the long run much better to do this house cleaning today.
Chris, outside of NYCB, isn't the market coming your way? Based on the fact we got JP Morgan yesterday closing at an all-time high, pretty decent month of gains for the banking index on the S&P 500 last month. Looking at the smaller banks, the regional banks, yes, a little bit lower through February, but nothing drastic given the challenges of this single name. Is the market coming your way?
I think so, John, and I think you're going to find the tangible book continues to grow for the companies this quarter. We have headwinds out there from higher interest rates. We'll probably see mark-to-markets go up again on higher rates at the end of March, but we can handle that. Most banks are managing expenses really well, and at the end of the day, the net charge-offs that companies are reporting are very modest. That's what's ironic about this. We're worried about stress testing, but we're ignoring the fact that net charge-offs have remained very low.
Nothing to see here. Chris Marinac of Janney Montgomery Scott. My words, not yours. I know, Chris. Ultimately making the point here, Bramo, that we shouldn't be down 30% if this is truly that kitchen sink cathartic moment for this name.
The second one. Again, I mean, I guess that's part of the problem is that they've had this before. It was a kitchen sink moment the first time. Typically, when you've kitchen sinked something, there isn't stuff left to kitchen sink again. So the question is, what's left? And then there's also clearly still nervousness about what we don't know in certain banks, some of the risks that we haven't fully priced. And that's evident in one name, not the rest of the
I don't think we want kitchen sink volume 3. anytime soon. Coming up on this program, President Biden, Donald Trump offering two very different visions on the southern border. We'll be catching up with Greg Valliere of AGF Investments on immigration and the election. That conversation just around the corner from New York City this morning. Good morning. Equity futures on the S&P 500 down just 0.1%. 4 months of gains on the S&P 500, heading towards just about a second consecutive week of gains as well on the S&P and the Nasdaq. We are basically unchanged. The Nasdaq going nowhere. On the S&P 500, down around about 0.1%. Yesterday, PCE basically comes out in line. In line is the new beat for inflation in the bond market. It meant yields came back lower, down from the highs of the year on a 2-year. We're down to about 459. We were through 470 earlier this week. 459.35 on a 2-year, Lisa, down 2 basis points.
It's taking off a tail risk. Essentially, things to worry about. The list got a little shorter, at least for the moment. Basically, people thought maybe we would see an upside surprise to inflation, and then we could be worried about sticky inflation and runaway, a sense of an economy where you don't get the immaculate disinflation everyone was hoping for. And then it came in line. That tail risk taken off the table. Back to the races.
Quite a turnaround for the bond market. Let's talk about a turnaround for dollar yen as well. Switch at the border, get to foreign exchange. Dollar yen, first close sub 150 in about 2 weeks. In fact, I think precisely 2 weeks. 150.45, back above it this morning by 1/3%. So we have a weaker Japanese yen. Here's the latest commentary from the BOJ. Bramo, work with me. We are not yet in a position to foresee the achievement of a sustainable and stable inflation target. The governor, Ueda, basically pouring freezing cold water over any kind of imminent rate hike from the BOJ.
Someone who isn't familiar with the story and hears that is thinking, I don't hear anything but blah, 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 blah. This is how the Bank of Japan communicates, right? On one hand, we might be getting closer to some sort of level that the Bank of Japan was looking for yesterday or 2 days ago. And then Ueda coming in saying, not yet. And this is enough to cold pour water. This is the reason why we're not seeing massive moves, more than just sort of incremental around 150.
This is a policy effort that is decades in the making, not years. Decades. Whaley of BlackRock talked about this yesterday.
Yes.
You have to remember that. They're not going to move like Chairman Powell's going to do a news conference and say, let's go.
Right.
You're going to get a surprise at some point from the BOJ, but at the moment they're not willing to surprise us based on this communication.
I'm old enough to remember when we thought that this was one of the tail risks. This was on the list of worries. That
Is this no longer on the list?
I don't think it is. I think that we can remove a sudden move from the Bank of Japan from the list of potential worries because they have shown time and again that they are in no rush.
You can clip that. You can sort of clip that and maybe play it out later this year. We will see if that should have been on the list. Dollar yen right now, 150.43. We're positive 1/3%. Under surveillance this morning, our top stories. China's factory activity shrinking for the 5th straight month. Another sign of weakness in the world's second largest economy. The country also seeing a continued slump in its housing market. The value of new home sales from the 100 biggest real estate companies sliding 60% from a year ago. 60%. February sales were down nearly 21% from January. Those numbers, Bramo, ugly.
Especially because a lot of people seem to be coming on the show and getting slightly bullish, at least as a trade, on Chinese equities. I will note this. Michael Hartnett from Bank of America saying that Chinese stock funds saw their largest weekly outflow in the past week since October. So maybe people who are viewing it as a trade see it as sort of reaching the end at a time where the data really isn't turning around that much.
Speaking of a trade, the market was up 9% in February. That's quite a squeeze. That's quite a run.
Squeeze is the right word. It's not as if people are just
squeeze.
This isn't people running into that nation's stock market and saying, let's go. This is people saying, how bad can it possibly get? And that seems to be where that is sort of fluctuating at a time where you're seeing people maybe close out that trade.
Hasn't had that warm, cozy, friendly feeling for international investors over the last 12 months, that's for sure. Let's turn to the central bank speak. Fed Presidents Williams, Daly, Mester and Bostic saying cuts will come once the data improves. San Francisco Fed President Mary Daly telling Bloomberg, quote, there's no imminent risk to the economy. March is a busy month for central banks. We've got the Bank of Japan's Ueda telling reporters yesterday that a stable inflation target might not be in sight. The comments weighing on bets the BOJ will hike on the 19th. The ECB is going to decide next week on the 7th. Then the Fed decides on March 20th. OK, let's spin the wheel. Which one do you like? Out of the three, which one are you focused on? ECB, BOJ, Federal Reserve?
I would say actually more ECB. The Federal Reserve, we hear a lot from. I'm not really searching for indications of where their minds are at right now. But the ECB, I think, has a more difficult nut to crack, given the fact that their inflation rate came in hotter than expected this morning. And it's completely modeled country to country. They have a different kind of mandate than in the United States, where there is one nation, albeit fractured. You have a lot of different nations with different economic profiles and different inflation outlooks. And that, I think, is much more challenging at a time where they're also facing weakness.
The growth profile is drastically different. Europe versus the United States, and has been for a while. Callum Pickering, by the way, of Berenberg, is going to join us shortly on that story. Here's your next story. President Joe Biden and Donald Trump clashing on the southern border.
This is a Joe Biden invasion. This is a Biden invasion. 3 years ago, we had the most secure border in history. We had the most secure border, and people weren't coming because they knew they weren't going to get in.
So here's what I would say to Mr. Trump. Instead of playing politics with the issue, instead of telling members of Congress to block this legislation, join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
President Biden challenging Trump to make progress on immigration after helping to sink a deal in Congress as work on Capitol Hill stalls. The Biden administration is still mulling an executive order on the issue. Greg Verdier of AGF Investments joins us now for more. Greg, that's the rhetoric, the talk, the politics. Let's talk about the policy. What kind of policy change are you expecting sometime soon?
Probably none. I think it's unlikely that we can get Biden and Trump together on this issue. There still is a desperate need to aid Ukraine, and that is a driver for many people on Capitol Hill. So I'd say maybe there's a 1 in 4 chance we get an immigration revival of legislation along with a Ukraine deal, but the odds are below 50%.
Well, Greg, what about an executive order then? Will Biden be pushed into trying to do something before the election?
Yes, he needs to do something. I think this perception by the public that Biden doesn't have a plan, that he got caught off guard, it has hurt him badly. And if Biden loses the election, I would argue he may lose because of immigration more than any other issue. So you're right. He has to do something. I wouldn't rule out an executive order fairly soon.
Our polling data yesterday showed that swing state voters mostly blame Biden, but we are seeing a little bit of an uptick of individuals blaming Republicans as well, those in Congress and the Trump administration. Do you think Biden is able to turn this around the way, say, Tom Suozzi did and push it to Republicans for not willing to meet him on a deal?
Well, he'll try. And I'm old enough, I don't remember Harry Truman, but I've read a lot about Harry Truman, who won a surprise re-election based on fighting against a do-nothing Congress. And if you see Joe Biden say it's a do-nothing Congress day after day after day, it might sink in.
Can you set the record straight, Greg? What can Biden do single-handedly versus does he need congressional sign-off in terms of some sort of presidential order to take care of something on the border?
There's not much. And there's not much he can do for Ukraine, sadly, or Israel or Taiwan. Those are gridlocked. I do think there's going to be a budget bill. Finally, this long, torturous, dysfunctional fight may come to a close because April 30th is crucial. That would require still a new extension. But on April 30th, if there's no deal, we have automatic across-the-board spending cuts, and I think nobody wants that. Certainly no Democrats want that.
Although it seems like people kind of expected this sort of kicking the can down the road that we got, and we're not going to get some sort of government shutdown. Does it give you any hope that we're going to keep kicking the can down the road, which I guess is the best case outcome that we can have right now in Washington, D.C.?
It's the best case. We'll kick the can probably again. We have new deadlines of March 8th and March 22nd. I think they'll be kicked down the road. You know, if we get into the summer, they may just say the hell with it. We'll just do a bill for the rest of the fiscal year. That could actually happen, and they'll start all over again on October 1.
Greg, let's talk about money. Biden's got a lot of problems. Money ain't one. And I'm not talking about the beach house in Delaware. I'm talking about campaign fundraising. Right. Bloomberg's Bill Allison reporting groups allied with Biden have already committed to spending more than $700 million to help him beat Donald Trump in the 2024 election. How important is that going to be?
It's huge. It's a sleeper issue, John. Biden was out in California a few days ago raising more money. So there'll be no shortage of funds at all. At some point, money loses some of its clout. But I think that right now, the financial advantage for Biden is significant. It's one of many reasons why it is way too early to count him out.
When you look at the other side, the Trump money, a lot of issues there because he's using campaign donations to pay for his legal bills. What kind of cash strap is he going to be in come this summer?
You would think it would be considerable. Nikki Haley has fired away aggressively on this issue without many results. But no, I would say by summer, the legal nightmare for Trump is going to be draining finances by quite a bit. It's a big issue.
Just to follow up and sort of switch gears and end on something, one of my other worries, this is one of my top worries right now, which is what PIMCO is talking about, the deficit, the fact that we are facing off with both candidates not willing to cut the deficit. We talk about this ad nauseum. Everyone's like, all right, we know this. But there is this feeling that there has to be a higher premium, term premium in the yield space to really offset the risk that seems to be evident to everybody. And they say it's starting to take hold. How much does the bond market have to sell off before Washington takes notice?
It's a great question. You talk to people on Capitol Hill and they really don't want to address it. They can't figure out what the prescriptions might be in terms of spending cuts or tax increases. We had in the year that ended on September 30, a deficit of like 1.8 trillion with a good economy. I mean, God forbid the economy should be softer and rates higher. It could go even higher than that. And yet I don't sense any kind of urgency on Capitol Hill.
Hey, Greg, I'm not sure when you'll get some. Greg Valliere of AGF Investments. That will come down to whether this bond market actually sells off in the fashion that would require some action. That's where the pressure needs to come from, Bramo. Haven't seen it yet.
We saw a PIMCO paper, though, yesterday on this point, and there are lots of papers being written on it. We're not necessarily seeing the bond vigilante movement, but they're basically saying that this could lead to a higher structural term premium. Basically, yields are going to remain higher regardless of inflation on the longer-term treasuries, and this could affect everything in the space that everyone's buying into right now. Again, this has basically been the person who cries wolf time and time again. Has something shifted? And everyone who I talk to says, maybe, and then other people say, but it's the yield.
You've made me smile so much in the last 40 minutes. How long is this list? And is European chocolate on it? That's what we want to know.
100%. It actually is.
Chocolate's on the list?
Yes.
OK.
Well, it's also the policies behind it. Just not because I agree or disagree, but just it raises a new specter of risk in fiscal policy and tariffs, I think are important also. That's also a tail risk.
I was trying to work out the chocolate fiscal policy connection. But I understand the tariffs and all of that stuff.
Yeah. I mean, I also, chocolate's important. And if you start having less chocolate in Mars bars and things of that nature.
Shrinkflation.
I mean, well, it's not just shrinkflation, but quality inflation.
Is the president actually going to talk about this in the State of the Union next week? Is he actually going to talk about this shrinkflation
Political reported that he's going to spend some time, or they're debating how much time they should spend on shrinkflation. My guess is they think it's landing. The issue is, when the president talks about shrinkflation, he's just hammering home the issue that consumers have right now, which is it reminds them that, there is inflation, and it wasn't here prior.
This issue has been around for decades. We've been talking about this for ages. Why all of a sudden are we jumping on this bandwagon? This has been an issue forever.
I mean, I guess because certain things weren't sticking, so let's try this one. I mean, how many times?
Throw it at the wall.
I mean, honestly, when you get a box of cereal, and I know you don't do cereal all the time, but I will say when you used to get a box of cereal.
Cattle feed for humans. You know my view on it.
So if you get it, it's like, a quarter filled, and then they say, well, they just want more space to kind of cushion it, but it's, filled less and less.
But to your point, companies have been doing this for decades. They have to, this is capitalism. If their input costs are higher, they have to figure out a way to either raise costs or put less in so they can also make money.
Equity futures right now negative about 0.1% on the S&P. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russian opposition leader Alexei Navalny will be buried today in Moscow amid heavy police presence. Riot police have been deployed near the church and metal barriers were erected on the streets ahead of the funeral service. Navalny died on February 16th after falling ill in a remote Arctic maximum security prison. Dell heading for its biggest gain in 6 months, up some 23%. It reported fourth quarter results that beat expectations. Analysts say demand for AI servers is driving the momentum. The stock has more than doubled over the last 12 months. Elon Musk is suing OpenAI and its CEO Sam Altman, alleging they have breached the AI startup's founding agreement by putting profit ahead of benefiting humanity. The 52-year-old billionaire says the company's close relationship with Microsoft and the makeup of its new board undermines its original mission, that being of creating open source technology that wouldn't be subject to corporate priorities. Musk was one of the early funders of OpenAI. And that is your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the Fed in no rush to cut.
Eventually, I do expect us to cut interest rates later this year.
We are ready to make moves and adjust as the data demand us to do.
It'll probably be appropriate to see us to start to reduce rates in the summertime.
That conversation coming up next, live from New York City. This is Bloomberg. Equities on the S&P 500 negative here, but recovering. We're off session lows. We're down here by about 0.07%. Under surveillance this morning, the Fed in no rush to cut rates.
Eventually, I do expect us to cut interest rates later this year. But really, right now, there's not a sense of urgency to do that.
We want to avoid holding on all the way to 2%. We are ready to make moves and adjust as the data demand us to do.
It'll probably be appropriate if things go the way I expect. To see us to start to reduce rates in the summertime.
Here's the latest this morning. Fed speakers waiting on the data, continuing to push back cuts until later this year. PCE inflation data rising in January at the fastest pace in nearly a year. The latest US payrolls report due a week from today. Bloomberg's Callum Pickering sees the Fed cutting 4 times this year, starting in June, with the economy heading for a slower down rather than a landing. Callum Pickering, Berenberg's senior economist, joins us now. Not Bloomberg's. I'm just used to seeing that B and reading Bloomberg. Berenberg's Callum Pickering joins us now.
Welcome.
How are you, sir?
I'm good, thank you. It's good to be in New York.
Good to see you. So the good news is that we didn't get bad news yesterday. Is that right?
Yes, more evidence that the US economy is just sort of humming along nicely, may slow a little bit in the first half of the year, but yeah, it looks like it won't land, but just slow down, which is a good outcome.
We've seen a really synchronized hiking story from the Federal Reserve and the ECB. How synchronized do you think the cuts are going to be?
Let's see. I think the risk is that the Fed goes less rather than more. I mean, remember last year we were discussing what this whole question around the inverted yield curve but no recession actually means. And we just got to ask at this stage, so which price is wrong? Is it the 10-year or is it the short end? Okay, the short end maybe is 50 or 100 basis points too high, but you still need a little bit more on the long end. It's entirely possible that we're just adjusting here to a higher growth, slightly higher inflation environment. We've completely left the low interest rate world, and we're just having a little bit of a problem here, and central banks are having it too, just understanding what's the normal rate of growth for real GDP, where will inflation settle at, and what interest rate will you need just to balance the economy. And all of the upside risks in the US that we would have been hoping for last year seem to be playing out on employment growth, on productivity growth, on demand. The government's getting away with a lot of good fiscal stimulus. It's a nice story at the moment for the US.
All right, let's sit on that. Good fiscal stimulus. I keep thinking about how much money is kind of going into this market as there seems to be endless liquidity. What is the US doing that Europe is not, that's making it flush with cash and that's supporting growth?
Okay, first question is, what can the US do that no one else can do, which is run a 7% deficit because it has the reserve currency of the world. But then you say, what do you spend that deficit on? 10% rise year over year in investment growth. Fiscal policy in the US is tuned towards boosting the net assets of the country, boosting supply, and adding to long-run growth potential. The major fiscal acts are not simply just knocking down old coal-fired power stations and building new, yes, greener, that don't produce more electricity, but just add to the debt. You're adding to productive capacity right at the time when you have, well, a normalization in demand growth because you've fixed most of the GFC problems.
So are you making the argument that we could see this growth and this flush of liquidity from fiscal without any kind of inflationary surge?
The US seems to be matching demand and supply better than any country at the moment, certainly better than in Europe because we're much more exposed to the global supply shocks. But whilst we have the hope that this can continue, strong growth at acceptable inflation without the need to cut much. Look, if the Fed only goes 2 or 3 times this year because US growth surprises the upside, that means bond market volatility, but net as an economist, of course, I'm happy about that. The risk for me is what happens next year. We are running an economy very, very close to balance between supply and demand, but we're matching, so that's okay. If you end up with a president, let's not name any names, that raises import tariffs, reduces net immigration, and then decides, actually, I want even stronger growth than Mr. Biden, so I'm going to cut income taxes, immediately then you have an inflation problem, and this story changes. So it's very important not to adjust policy now, and just to let this economy do as it's going to do. And if the Fed feels it can just take its foot off the brake, great. If it can't, because we have more growth, then I'll be happy about that.
Well, Callum, how do you start preparing for Trump 2.0?
Well, the market's going to wait until the 4th of November, right, and then decide which way it should make up its mind. We're always overtaken by events in life, and so we shouldn't be assuming that the next 4 years looks a certain way. A lot depends on how Europe reacts to geopolitical risks, but for me, purely from a macro perspective, as long as fiscal policy is oriented to the supply side and the US continues to enjoy good employment growth, it's a real question of whether inflation settles in high 2s or low 2s. If it's high 2s, well, we can live with it as long as the Fed doesn't ease too much.
We've been talking about the deficit a lot. At what point are bondholders going to want more to hold US debt?
Well, so long as you don't have a major inflation problem, I don't see why we should be pushing up US rates significantly. Maybe they need to be 50 basis points higher, but that as much reflects the upside risk for real growth as it reflects upside risk for inflation. If fiscal policy were to change to be demand-focused instead of supply-focused, then you would worry about these inflation problems. Remember the lesson of Liz Truss in the UK. The reason why those deficit spending plans panicked markets so much is because in the short run, they were inflationary in an economy that was supply constrained and had tight labor markets. It's really important. Why are you spending this money? Are you raising demand when demand is already strong enough? Or are you trying to raise supply in order to match the increased demand? And so a 6% deficit that's supply focused, the US gets away with. Other countries probably couldn't.
Interesting. Liz Truss, quite a lesson. Quite a lesson. We could talk about that lesson another time.
It was Reaganism without the dollar.
Laura Rain coming up a little bit later from FS Investments. She's saying that she supports a renormalisation of rates at a higher level. What's changed between 2019 and now? What's changed structurally that would lead to that kind of outcome?
Let's imagine a world where we didn't have COVID and we didn't have the Russian invasion of Ukraine, so we removed these big supply shocks. US rates would have been drifting higher already, this neutral rate, just as we solved and escaped that weird funk after the post-financial crisis period. The Fed had already started to react to this change from 2017 onwards, but then had to adjust rates downwards because of these two huge shocks. And so neutral rates have drifted higher. And so you can ask the question, I know this side of the pond you like to refer to R star, so let's go with that. R star is maybe 4%, maybe even a little higher, which means we only have 100, 150 basis points of tightening, not 500 basis points of tightening, which is why inflation expectations have only come down a bit, why the housing market has corrected but consumers haven't completely panicked, and why the jobs market has slowed rather than fallen off a cliff.
You've teed up an obvious question. Are we sufficiently restrictive based on that? Because the Federal Reserve seems to have a very different view on where neutral is.
Well, I think we're going to find out where neutral is. I think it's hard to be very precise at this moment. I fear more killing inflation rather than allowing the economy to run a little bit hot. Because remember, our markets are not really systems, they're adaptations, and they adapt through prices. And so a world where prices grow at 1% is not sending you a strong signal about investing here, investing there, hiring here, firing there. The moment you have 3% price growth, suddenly you have strong signals to do something. Those signals are necessary. And so I would prefer to say, let's run the economy a little bit hot for a while and let this renormalization just take place than risk killing the upswing and going back to a 1% inflation.
A lot of should versus will. Can we just clear that up? I know what you think they should do. What do you think they will do this year?
I think June is going to be a massive month for markets. I think the Bank of England, the Fed and the ECB are probably all going to cut rates. And then it's a question of how far they go. Base case would be 4 for the US. I think 4.5 you can get to. And then there's a question of whether or not they can go 50 more next year. Base case would be, but I think it's a close call.
Bramo with the face.
Well, 4, I mean, it just seems like if things are surprising to the upside in terms of economic growth, why would they cut more than they're saying now?
We were, second half of last year, US around 4% annualized. That's probably twice the rate of potential growth. This First half, we're probably going to slow to slightly below 2% annualized. Inflation is probably going to come down a little bit. And so the Fed will probably get an opportunity in Q2 to start cutting interest rates. Then, well, you just have this institutional momentum. You'll cut a few times in a row. And then in the second half of the year, let's see if inflation expectations and inflation starts to creep up as the economy starts to reaccelerate. And then you'll ask the question, when can the Fed stop?
Got it. We've said it a few times, haven't we? We need the Bramo cam. You just need to see Bramo's reaction as guests are speaking. Just to know what...
probably would check me, and I'd have to actually pay attention.
What Lisa really thinks about stuff. Callum, it's good to see you. We're in New York. Thank you, buddy. Berenberg's Callum Bickering there. Coming up on this programme, Avery Sheffield of Vantage Rock, Megan Robson of BNP Paribas, Bloomberg's Mario Parker and Javier Blas on Guess What? We'll talk a little bit of oil, but Bramo demanded it. A chocolate conversation with Javier Blas.
Everybody wants to know.
Okay, cool. That's coming up next.
Chocolate.
It's coming up next.
Easter.
They're coming
Bunnies
after
are
it.
Going to be expensive.
They're coming after it.
Who's that?
Rates market moving closer to where we think things should be, which is around 3 cuts.
There is certainly a lot of risk that the Fed waits a little bit longer. They're likely to err on the side of caution.
The big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
I think it's becoming increasingly likely that maybe we have no rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This story has changed so much in the last 2 months. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. Your equity market on the S&P 500 almost totally unchanged. Just to wrap up the data in February, starts with a blowout jobs report. CPI, upside surprise. PPI, upside surprise. PCE comes in line. And this is what Evercore's Krishna Guha's got to say. No new bad news. And ultimately, that's what this market traded on yesterday.
Everyone's looking for the tail risks. That's why I have a list of worries, and it's getting shorter, but I can add some things. There are some issues, though, with this idea of can we get continued growth and upside surprise without commensurate inflation? There was a hot second. People were worried. Maybe it was picking up again. PCE wasn't surprising, and everyone went back to their Goldilocks nirvana.
And the stocks look good. Stocks just had the best month since November, despite everything that Bramo just said. The S&P 500 up on the month by 5%. Euro stocks 50 in Europe up by a similar amount. The Nikkei 225 over in Japan up 8%. Even the CSI 300. I'll keep going.
Please.
Just to torture you with
everything.
It. Even the CSI 300 in China up by 9%. AMH, that is a decent month of gains.
It's a massive month of gains around the globe, yet Japan is in recession, Germany is in recession, the United Kingdom is in recession. So sometimes it's hard to understand the economy versus the stock market.
Well, I keep going back to people having a sort of out west view of the Fed and the ECB. They're locked and loaded and ready to go, and boom, boom, boom. They can, respond to any weakness with cutting rates. And that's the big hope. But to me, it's just unclear whether we can get growth without inflation, whether the AI boom is going to bring the productivity and this perfect kind of evolution that everyone's looking for.
You want some negativity? Would you like some? Okay, sure. Single name, NYCB. Here you go. Down 26%. This market has decided this is an isolated issue. JP Morgan yesterday, record high. The banking index on the S&P 500 basically performing in line with the index on the S&P, up by something like 4 or 5%. Regional banks, even the regional banking index was only down about 3%, and we've known about this issue all month.
I mean, people have been trying to sniff out who the losers are in the small banks space for about a year. So if they've been spending a year trying to sniff it out and trying to reprice according to how much their commercial real estate holdings are and parsing through their books, is this really going to surprise them? I guess the biggest surprise to me is, given that, why are people not more alarmed that they haven't seen everything with one kitchen sink and then another kitchen sink and having all of the concern already baked in?
NYCB down by 26%. Bramo's list gets shorter. I'm not sure if that's bullish or bearish. I've got no idea. Coming up through the next 60 minutes, Avery Sheffield of Vantage Rock on why she sees downside risk to markets. Javier Blas of Bloomberg Opinion, with OPEC Plus likely to extend voluntary supply cuts, and a little bit on chocolate as well, apparently. And Megan Robson, BNP Paribas. with credit spreads at multi-year tights. We begin with our top story this hour, kicking off a new month with stocks at record highs following a fourth month of gains. Avery Sheffield of Vantage Rock saying this: the market is partying extremely hard right now. Well, I'm not here to say the party may be over. Valuations are stretched and fundamentals are being overruled. We think that this creates underappreciated downside risks. Avery, you sound like a guest that Lisa booked. Let's talk about those downside risks.
Exactly.
Welcome to the show. What are they? How long is that list?
Yes. Well, I think the risk is really in terms of what's already been priced in, right? So as you've been speaking about, we're running a 6 to 7% fiscal deficit in that type of environment. It's really hard to see much economic downside absent some geopolitical risk or conflagration of something happening in the banking sector, which we're not predicting. And so the economy looks like it is humming along. It's okay, but from a stock perspective, what's priced in, right, with the NASDAQ at 29 times, with S&P, nearly 21 times, with real rates, the highest they've been since the GFC, like there's a lot priced in. And so I think what it means is that when expectations aren't met, the downside can be very meaningful. But we would say it's probably more likely to happen on a stock-specific basis rather than for the market as a whole, given, again, the very generous spending from our federal government.
I remember you said something about Chairman Powell last time we spoke, something along the lines that his ultimate goal wasn't price stability, it's to make people happy.
Yes, exactly.
Is that still your description of Chairman Powell?
Yes, well, I think he was listening because since then, right, in the January Fed meeting, he did come out and even say explicitly, which I think was, it was a little refreshing that, wow, inflation actually looks like maybe it's picking up a bit and we're not going to likely to raise in March. And you've had Waller out there, even Mary Daly, this week on Bloomberg saying that consumers are concerned about inflation. It's one of their top risks. And so we can't really we can't really lower rates to continue to stimulate the party in the way that it suggested that he might from his comments in December.
So this was something that I thought was interesting. He said all the right things to make people happy, but he didn't really address the issue of financial conditions easing and what that would do to really push them further away from their goal.
Yes.
Do you think that that's because it's no longer relevant, or do you think that it's because they're just not aware of how much the incredible easing in financial conditions has really made it more difficult for them to conquer inflation?
Right. Well, I think at that moment in time, he just didn't want to stop the party, to be quite honest. I mean, it was so clear that financial conditions had eased so much. But he was probably hoping that inflation wouldn't reaccelerate for a while and he would have some leeway to begin cutting sooner rather than later to keep everything on kind of a steady course. But because inflation has reaccelerated, because it's still so prominent in consumers' minds, now the easing of financial conditions is flowing through, I think, so quickly that they've had to walk back kind of this more, financial conditions don't matter. We're just going to do, what we're going to do. But they're flowing through. And so they're having to respond to it. And to your point you've been making, Lisa, can you really ease without reaccelerating inflation? And so many stocks right now are priced as if the Fed is going to ease and that is going to stimulate demand from the current level, rather than that the Fed would only ease in response to actually things getting a bit worse.
So this morning I walked in and I said, everyone's talking about this partying as if it's a negative. What if it's a positive? What if there's nothing wrong with this party? Because we have a lot of cash in the sidelines. We've got just as much money going into cash funds as you do, actually more than you do having going into equities. Is this healthy?
Well, the issue is that it's leading to continued inflation, which consumers aren't happy with. If consumers were happy with inflation, if they were happy with their chocolate prices, if they were happy with their Happy Meal prices, if they were happy with the cost of housing, it wouldn't matter. But consumers aren't happy. And so that's where we have this issue that you can't just keep stimulating the party and have people actually be happy.
But we see a divergence in consumers, and you talk about this in your notes, a tale of two cities.
Yes.
Get into that with us, because not all consumers are not spending.
Right. So the high end clearly is continuing to spend. It's really the low end. Well, they're continuing to spend, but they're not happy with where they're spending, right? Too much on chocolate, too much on coffee, not enough money left for discretionary. But those higher end consumers are continuing to spend. And I think this is one of the issues that we're facing, is that if everyone wasn't spending, it would probably lead to deflation. but enough people out there are spending that it creates inflationary pressure for everyone. And so it makes, the Fed's tools are very blunt of lowering rates, right? It stimulates demand for everyone, and the low-income consumer gets hit more. And so I think that's a real issue. And we do think that is going to keep the Fed more in check for longer. And it means that these stocks, especially in the consumer sector and other sectors, that are being priced for a Fed cut, stimulating demand from these levels, are unlikely to live up to those expectations.
That's the third time you've alluded to this, so I can't let you escape without giving us more detail. The risk at the single name level.
Yes.
What are these names? What are these companies?
So I prefer not to speak about single names, but I'll just speak out about more generally what we're seeing. So when you have, like, in areas of the economy, so in the consumer sector, you have stocks priced at 30 times, 40 times earnings that have been real leaders, that have been brands that people have loved for a long period of time, that are facing increasing competition, that were benefited from lower income consumers or middle income consumers trading up, that are not reflecting those risks. So, like, that's where I look in the consumer sector for more downside risk. Also, companies that are sell furniture, home improvement, everyone's pricing in these cuts, re-stimulating demand. And I think the demand might fall further before it comes up. Then you look at the software sector. In software, I mean, we've seen this week, right, very different results from different software companies that are priced for perfection and maybe benefit from AI, but not as much as people think. We're already seeing those kinds of stocks really correct. And I think we'll continue to see this kind of rolling bubbles deflate, while companies out there that don't have that bubble-like dynamic, that benefit from an economy that's rolling along, actually have some opportunity to the upside. I'm not saying everything's going down.
Given the names that you've just cited there, though, you didn't do them specifically, but I can say them for you, maybe sort of like Depot Homes and Throws, like those kind of companies, rhymes with. Did I do that right? You
really
love
good.
doing that. Thank you.
Rose, whoa, that's good.
Right, thank you. How insulated will the index be, given their very small weighting on the S&P anyway?
Yes. So for the S&P as a whole, and I was speaking specifically about those types of companies, but for the S&P as a whole, right, you have kind of your Magnificent Seven. The performance of the Magnificent Seven has really diverged underneath the surface. I think it's emblematic of what we're going to see in the market as a whole. And so will 4 of those names that have done the best this year be enough to offset potentially some weakness and, like, 2 others, maybe a little softness in 3 of the others? Like, that is what's probably going to drive things at an index level. But we've already started to see that bifurcation, and the level of valuations that we see within those companies elsewhere suggests, I think it's hard to make a call on the index as a whole.
I love your idea about specific companies. This brings me to French call centers. And I really do think that this actually is one of the most, it actually is really an important story. So this is a company that totally fell out of bed because Klarna said that its AI assistant is doing the equivalent work of 700 call center employees, and had 2.3 million conversations. First of all, anyone having a conversation with a bot, good luck. But I am curious about how many teleperformances there are out there.
Right, there are more, and I do think that is an area, absolutely, where we're going to see almost, AI having more earthquake-type shocks rather than AI being a rising tide that lifts all boats. So we are certainly, as we look at companies out there, there are these really overvalued companies that won't meet expectations. There are also companies that are likely to be disrupted and don't have it priced in.
Avery Sheffield, thank you. Enjoyed that. Avery Sheffield, Advantage Rock. Morgan Stanley's Mike Wilson talked about this, the difference between AI enablers, NVIDIA, etc., and AI adopters. And I think the second piece of this is the piece that you're alluding to, how this is actually going to play out in practice and which companies will take it on and succeed and others which might struggle and fail.
I love this story. And it's hard to talk about in generalities, but there are certain companies that are going to do much better with respect to productivity. And then there are going to be those that in 2 weeks are going to be called out of business because basically their entire business model is getting disrupted. That's fascinating. And that, to me, that kind of under-the-hood work that doesn't really lend itself to morning TV is really interesting.
I'm interested too, and I think it does lend itself to morning TV. How labour-intensive, how labour-light will some of those companies be? And what are the job losses going to look like? Where will those job losses be? In the West, you're going to find them over in Asia, in places like India, where a lot of those call centres moved to at certain institutions over the last few years.
It's a great point in terms of cheap labour and where it gets blown out in particular and how that affects different economies. I would also argue in the U.S., there are something like more than than 1 million grocery store cashiers. You think about jobs like this that are the rank and file. What happens to all of those jobs down the line?
Cheap labour, chatbots. That is the issue.
Yeah.
Big issue. Equity futures right now on the S&P, negative 0.1%. Lisa just makes it feel so small when she talks about French call centres being on this list of worries. But I'm with you. You need your weekend, don't you?
Amen.
I know you do.
Amen.
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Eurozone inflation eased less than forecast in February. It backs the more cautious ECB officials. Consumer prices rose 2.6% year over year, slightly above estimates. The ECB meets next week. President Biden will push plans to increase taxes on corporations and the wealthy and lower prescription drug prices in his State of the Union address. He plans to lay out his economic agenda for a potential second term in office during the State of the Union Thursday evening. Treasury Secretary Janet Yellen says any plan to seize Russian assets cannot be seen as a replacement for Ukraine aid. Aid has been held up in Congress as the country's war with Russia enters a third year. She's speaking with Bloomberg and said the EU has offered Ukraine, quote, very meaningful financial, but the total just doesn't seem like enough. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, a battle at the border.
This is a Joe Biden invasion. This is a Biden invasion. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
We'll head down to Washington, D.C. for that conversation next. Live from New York. Good morning.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
Two hours, 12 minutes away from the opening bell. Equity futures on the S&P 500 negative here by 0.1%. Yields a little bit lower by a single basis point, 423.65 as we head towards the weekend. Under surveillance this morning, a battle at the border.
This is a Joe Biden invasion. This is a Biden invasion. 3 years ago, we had the most secure border in history. We had the most secure border, and people weren't coming because they knew they weren't going to get in. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Instead of playing politics with this issue, instead of telling members of Congress to block this legislation, join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
Here's the latest today. Donald Trump and President Biden making dueling trips to the US-Mexico border as immigration continues to hold up spending bills in Congress and is a key issue in the run-up to November's presidential election. Bloomberg's Mario Parker joins us now for more. Mario, the rhetoric is far apart. How far apart are they on policy as well?
Oh, it's night and day in terms of the gulf between Trump and Biden on policy. I mean, but to be sure, I mean, recall that Republicans essentially exacted exactly what they wanted out of President Biden in terms of an immigration and border deal, and then they reneged on that deal early in February at the behest of former President Donald Trump, who wanted to keep the border and immigration as a political vulnerability for his opponent as they look ahead to November.
But when it comes to potentially an executive action, Biden would have to use the law 2212F that former President Trump wanted to use. And this would be suspending the entry of these foreigners when it's determined that their arrival is not in the best interest of the country. If he was to go that route, how much pushback is he going to get from the progressive left?
Oh, that's a great question, Annmarie. I mean, he'd get a lot of pressure from the progressive left. If you kind of see, I mean, he's been vacillating or mulling this for the last 2 or 3 weeks, particularly, as I mentioned, after that deal was scuttled, whether or not he has the executive authority to do something, right, vis-a-vis Donald Trump. Make no mistake about it. You all are in New York. We see some of the pressures that are on Biden's side from Democrats, right, not just the progressives, but centrist Democrats as well. Illinois, New York, York, some of these big cities that are being inundated with migrants based off of this gambit that Texas Governor Greg Abbott pulled. So Biden's just caught in between a lot of different pieces, both within his party, but then also in the Republican Party. However, the fact that we saw him go to the border was a follow-through of a promise that he said he was going to go out on the road and take this fight head on, try to explain to the American people the politics of what happened here.
Mario, you bring up a great point. Tom Suozzi, partially why he won is he talked about the border, and Long Island is a far cry from the southern border. What is Biden going to say, though? He just did this trip, but what is he going to say next week in the State of the Union about the border?
Yeah, well, it's quite unclear just right now what he'll say exactly, other than the fact that he's going to put the onus on Republicans. Again, he's going to point to the fact that he did concede to many of the Republican demands in that deal that they scuttled earlier this month, and that they've got essentially, he's going to cast Donald Trump as a puppet master over the Republican Party. The gambit on the other side, of course, is that Republicans feel as though it's just so entrenched of an issue for Biden that he won't be able to dig himself out of a hole. Now, in terms of the State of the Union address next week, Biden's campaign is casting that as his vision for America, his outlook, essentially another seminal moment in this presidential campaign. It happens 2 days after Super Tuesday. They want him to start having a vision looking forward and communicating that to voters, while also trying to explain to voters some of his key legislative accomplishments have improved their lives.
Is there any evidence that what Biden is doing in terms of trying to take the border issue head on to Trump's doorstep, saying you're the one that blocked this deal I could have gotten done when I negotiated with the Senate? Any evidence that's actually working in terms of voters blaming Republicans?
In terms of evidence, the evidence is scant, right? We had a Bloomberg Morning Consult poll over the last couple of days that came out that showed that more voters blame Republicans for what's happening at the border by about a 5 percentage point increase. That's not a whole lot, again, given just where Biden is on the issue. If you look at former President Trump's recent stump speeches, you can see semblances of what some of his key aides are probably telling him, because he said something the other day at a rally about immigration being baked for Democrats. One in our field can take that to mean that probably his analysts or his aides told him that it's so baked in that it's worth this kind of political gambit that he's pulled off to convince his party to renege on that deal that they had.
Hey, Mario, great to get your thoughts, as always, buddy. Mario Parker down in Washington, D.C. on the latest, the difference between the former President Donald Trump and the sitting President Joe Biden on the southern border. Here's a headline for you. Torsten Slok, Apollo. The Fed will not cut rates in 2024. It's quite a call. The reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. He offers 10 reasons. There's a very long list of reasons. I'll go through the 10 for you. I'll shorten them down and just go through the bits that he highlights in bold. The economy is not slowing down. It is re-accelerating. 1. 2. Underlying measures of trend inflation are moving higher. 3. Supercore inflation, a measure of inflation preferred by Chairman Powell, is trending higher. 4. The labour market remains tight. 5. Small business are planning to raise selling prices. I'll go to point 6. Manufacturing surveys show a higher trend in prices paid. 7. ISM services prices paid, also trending higher. Point 8. We're going to raise worker compensation as well across businesses. Point 9. Asking rents are rising, and more cities are seeing rising rents, and home prices are rising. And point 10, financial conditions, the obvious one here, Bramo, easing. Equity markets are rallying to all-time highs and credit spreads are very tight.
That, to me, might be the most interesting one, that essentially the indication that we got from Fed Chair Jay Powell at the end of last year has worked against their goal to try to get inflation down. And this is basically what Avery was talking about just a couple minutes ago, that it does matter. And this is really factoring into some of the strength. That said, how many people are going to come to his view? Because Torsten now joins the Jim Bianco camp. That was a very lonely camp and still is not being priced into the market.
I want to remind you how quickly things changed last year and how many times we had a different narrative in the first 3 months of 2023. We came into the year talking soft landing. February was no landing, almost exactly where we are right now. March, what happened? Banks started to fail, and then it was all of a sudden hard landing. I think, to Torsten's note, this is the way I would think about it. The probability around a range of outcomes has shifted markedly over the last 3 months. I have no idea where we're going to be at the end of this year, but the world has moved towards that perspective. The chances of that happening now are so much higher at the start of March than they were even a month ago.
There aren't the signs of the cracks that everybody was looking for. Again, that list of worries, tick by tick by tick, each one's being taken off. Unrest in the Middle East, oil prices aren't really moving. Yeah, they're ticking up just a little bit. Concerns about inflation, well, you know, that's kind of sticky around the edges, but it's coming in some places. All of these worries seem to be kept in check just enough for basically inflation to not come down as much as many people expected.
We'll turn back to that note in just a moment. Equity futures right now on the S&P 500, slightly softer. We're negative by 0.1% on the S&P. Looking at the bond market, Treasury yields lower by a basis point or two at the front end of the curve. We're down 2 basis points to, let's call it, 460. Coming up on this programme, oil capping a second straight month of gains as cocoa sees its biggest rise in 22 years. We'll dig into the commodity market with Bloomberg's Javier Blas up next on the programme. Not sharing my thoughts on that. No chance. Equities on the S&P, not a chance. Negative by 0.1% on the S&P. We're going nowhere on the Nasdaq 100. Torsten Slok of Apollo, the Fed will not cut rates in 2024. Here's the why. The reality is that the US economy is simply not slowing down. The Fed pivot has provided a strong tailwind to growth since December. What could this mean for this bond market? Switch out the board and get to the 2-year. This 2-year has been as low as 4.1% this year, as high as 4.7. At the moment, 4.6. Yields down by a basis point. Helped out by PCE coming in line with expectations yesterday. You get no hikes this year, so you've got to price out another 3 cuts this year. What's the upside potential on that 2-year?
We were hearing yesterday that it could be easily 5% from Ira Jersey, and a lot of people are saying, why wouldn't it be? Over the next 2 years, if you're talking about a Fed funds rate that's going to remain, at 5% or 5.5%. I love Torsten Slok's note, the way he began it, because it basically was, you all have been so bearish and you have all been so wrong. The market came into 2023 expecting recession. The market went into 2024 expecting 6 Fed rate cuts. You look at the data, and that's the reality, at least what we're looking at right now, and it's strength.
Can we get to point 10 on that long list of
Please.
reasons as to why they won't hike this year? Financial conditions continue to ease. Doesn't that become slightly more compromised as we start to come round to the world that Torsten Slok is living in, if we do indeed go in that direction?
This is the game theory of the moment that the Fed's in right now. That essentially, can they get to the inflation rate that they want if the market thinks that they're actually going to be accommodative and try to keep this party going, to use the parlance of a lot of our guests? And right now, you can see this play out in the mortgage market. When rates go down, even 0.5%, you could see people apply for mortgages. You can see that uptick in a significant way. Then rates rise back up, everybody goes away. Yeah. You can see it in real time. That is financial conditions easing and tightening. And really, you can see it.
3 cuts this year is consensus. No cuts this year is certainly not consensus, and you might say yet. In the bond market at the moment, we're down 2 basis points on a 2-year, on a 10-year, down a single basis point to 4.24. If you can turn to foreign exchange to switch up the board and get to the euro, talk about a euro that's slightly positive by 0.1%. Speaking of an ECB that might not be able to cut rates anytime soon, well, they might not be able to. Upside surprise on inflation, Bramo, over in the Eurozone. Look, it's coming down, it's coming in, it's still in at around 3, which is better than 4 or 5 or 6 or 7. We're moving in the right direction, just not as quickly as some people hope for today.
And where it's coming from is important, too. It's not coming from services. This is coming from other areas, the goods disinflation that continues. So at what point do you need to see services inflation come in much more aggressively for the ECB to get on board?
Governor Waller at the Fed said, what's the rush? And just listening to the Austrian Central Bank governor a little bit earlier this morning, you got the same feeling. That man is not in a rush anytime soon. Under surveillance this morning, your top stories: New York Community Bank shares plummeting. The company announcing, quote, material weaknesses in how it tracks loan risk. The bank saying the weakness results from ineffective oversight, risk assessment and monitoring activities. That's a quote no one wants to write. NYCB also announcing a change in management and warning investors it expects to miss a deadline to file an annual report as it shores up controls. That stock, Lisa, on my screen right now, it's off the lows. It's still down about 20%.
Yeah, I mean, it's trading sub $4 a share. So we're talking about a company that's been really beaten up here over the past couple of months. To me, I think the more interesting aspect of this story is how it is being treated as an isolated event. People are buying into the idiosyncratic story, hook, line, and sinker. And whether that's true or not, that shows you how much sentiment has shifted.
To be fair, for good reason. And if you are just joining us at home and you missed the numbers earlier on today, I think these numbers kind of matter, that their largest real estate exposure comes from $37 billion in apartment loans, with almost half backed by rent-regulated complexes. That issue is truly, I'm going to use that word, idiosyncratic.
And that's how it's being treated by the market. The issue that I have is, why did they not have a better handle on what risk management issues there were, say, a month ago when the kitchen sinked it the first time? Again, is this an NYCB issue? Is this a broader issue? So far, the reason why the shares are lower is because of that, but not more broadly.
Execution versus just where the market is, and clearly they had a big execution problem. Let's turn to the latest on politics. President Biden walking back his comments on a Gaza ceasefire, telling reporters he's hopeful but no longer expected to happen by Monday. The White House saying Biden spoke with the leaders of Qatar and Egypt yesterday. The two nations are helping to broker a peace deal between Israel and Hamas. Now, the cynical who are listening to all of this, AMH, they might say those comments were made just ahead of that Michigan primary to try and get some support that he otherwise didn't have.
Already, that's what people are saying. He wanted to make sure he said something about Gaza, about this potential for ceasefire, before he knew a lot of Arab and Muslim Americans were going out to vote. They were going to vote a protest vote. They don't want to see Biden as the candidate. He said hope springs eternal, so he's still hopeful. I think if a deal was to get done, it would have to be before Ramadan on Sunday. But I would note that yesterday there was a deadly confrontation in Gaza. And now you have the White House saying they want to investigate this. You have dozens of Palestinians dead. And that is going to make it much harder for this administration, because it's going to make the hostage talks much harder when you have continued flare-ups like this.
Yeah, the mood has changed pretty quickly. More on that a little bit later. Let's turn to the latest on Tesla, rolling out a number of incentives to drive sales in China. The company facing stiffer competition from local rivals like BYD. The incentives include insurance subsidies and discounts on some paint colours. Tesla's lowered the price of its Model 3 and Model Y cars in China by as much as 6% in January, triggering further cuts from local competition. I think we can call this a price war, with BYD slashing one of its models by 20%.
Can Tesla play? That's what I want to see. How much does this really cause a real issue for Tesla that already has seen its margins and its margin hopefuls come in quite a bit? Also, do they then have to cut prices in the U.S., or are these markets completely divorced from one another, as basically the U.S. says it's going to throw up the walls to any Chinese cars? That, to me, is going to be a really interesting conversation that we're going to continue to have.
Well, you're paying a little bit more than 27% tariff if you even wanted to import a Chinese car right now. So I think Tesla can remain competitive in the United States. The issue is worldwide. And Elon Musk spoke about this in the last earnings call. He said that if there aren't trade barriers, BYD would, quote, demolish the market.
Yeah, it's not about whether Tesla can compete here. It's about whether Tesla can compete there, whether they can and whether they'll be allowed to compete there. If you end up in this situation, Bramo, and we don't know what's going to happen here, but let's just go through the White House statement from the president yesterday on the national security issues around Chinese vehicles. Let's say they go as far as effectively banning these vehicles, that you can't buy them in America. Are the Chinese just going to sit there, the authorities, the CPCP, to allow foreign manufacturers to sell in their market when they can't sell abroad? What happens next?
There are a lot of people speculating there will be some sort of retaliation. I just think we can't really game this out in any kind of linear fashion.
It's hard.
And I think that the other question that I have is, what is the price at which an electric vehicle can be sold where you break even? And how does this really stymie if you have less competition? How much does this keep prices higher on electric vehicles ultimately in the United States that leads to lack of demand, which we've seen consistently?
You were brilliant at this yesterday. Yesterday, this was just slightly different. This wasn't just about unfair trade practices, their ability to produce these vehicles with cheap labour and big subsidies, state-sponsored industries. And let's be clear, we have a state-sponsored industry here right now in America as well, and over in Europe too. This was about national security. That's a very different ingredient.
Well, but how much
are U.S. individuals willing to pay for national security? How much are people willing to really go with this? And this is the reason why I say, yes, it's about national security, so it's going to go through. But what does that mean for electric vehicle adoption if people are going to ultimately have to pay higher prices? And that, I think, is something that a lot of auto manufacturers are grappling with right now.
Tesla just a little bit lower in the pre-market. No drama there. No drama at all. Oil posting a second straight monthly gain, with traders expecting OPEC Plus to extend voluntary supply cuts into the second quarter. Javier Blas of Bloomberg Opinion writing, quote, "The market anticipates a full rollover. Instead, I believe the cartel has a chance to add a bit of extra supply, taking some short-term pain for a long-term gain." Javier joins us now for more. Javier, can you walk us through that? What would the long-term gain be from doing that now?
Well, Brent crude is already at close to $85 a barrel. And I think that what OPEC is doing, if it continue to restrain production at the same level as it did in the first quarter into the second quarter, is going to continue adding a few more dollars per barrel to that price. And it's going to be subsidizing the U.S. shale industry. We know that each dollar matters in the Permian, that each dollar really triggers a significant increase in production. And I think that the time is for OPEC to say 80, 85, that's enough for us. We do not need to subsidize the U.S. shale industry, because if not, if OPEC continues to restrain now, what they're going to find is going to be a lot harder later on the year, because shale production is going to be higher than expected. So that is the gain.
There's a real question about where the sort of line in the sand is for OPEC Plus in terms of pricing. How low can prices go before it's unsustainable for a group of countries that have relied on crude income for almost all of their investments?
The main problem is you cannot ask that question to OPEC or to OPEC Plus. It very much depends on which country you ask. There are some smaller, richer countries in the Middle East, say Kuwait, the United Arab Emirates, which can live perfectly happy with current prices or even much lower. I think that some prices in some countries in the Middle East, $65, $70 is something that they can take. You ask the same question in Saudi Arabia. I think that the current price of $80, 80 to 85 is the bare minimum that they are prepared to accept. Very similar question in Russia. The key difference from like the OPEC that we used to know 10, 20 years ago, it is the Saudis who really want the high prices.
So what's the Saudi ceiling then, Javier?
I think that the Saudi floor for the price is somewhere around $80 a barrel. They want to guarantee 80, so probably they are aiming somewhere between 80 and 85. I think that they are very happy to keep oil prices all the way up to $100. They don't see a particular problem for the global economy at those levels that we have been before. They believe that the global economy can take it. So I think that the Saudis sit very comfortably somewhere between 80 and 100.
We're actually bearing the lead with you, Javier. You, before I'm going to reveal something, that you admitted that you are stockpiling chocolate. Why are you stockpiling chocolate? Do you really think that it's going to get that much worse out there?
I stockpiled of olive oil last year. I was very happy when the price went through the roof. I'm stockpiling some chocolate because we eat quite a lot at home. Must confess that. And the price of cocoa is up 150%. You make chocolate out of cocoa, a bit of sugar, a bit of milk. Prices of chocolate on the supermarket, it's gonna go up quite significantly over the next 6 months. The market for cocoa is facing a structural deficit. Supply is well behind the demand. Probably the gap between demand and production is going to be in 2024 the largest it has been at least in 65 years. So we have a problem, and the only cure for the market right now is higher prices. So we are going to see a bit of higher prices in the supermarket. So I'm just anticipating from that.
Higher prices, less chocolate. That's already what these chocolate companies are telling us, Javier. But when you look at the market in terms of cocoa, is it what's going on in West Africa in terms of bad weather and drought and disease on some of these crops? Or is it tariffs that are coming into play from Europe?
There is a mix of factors. I mean, certainly The weather has been very unfavorable. It has been dry recently. It was too wet a few months ago. We have new regulation from the European Union on deforestation, which means that beans that have been produced in new planted area cannot go into the European Union. That's not going to help. But I think that the biggest problem is that the world is relying on a group of West African countries for 60% of the cocoa. That's Ghana, Ivory Coast, Nigeria, and Cameroon. There has been very little planting in those countries for the last few years. The trees are old. They're producing less and less. And those trees are also more sensitive to bad weather and to disease, and we have had a lot of that in recent months. Diseases are really quite widespread, both in Ghana and Cote d'Ivoire, and Ghana and Ivory Coast, and that is the big problem at the moment. But it's a combination of all of the above, which is really restraining supply this year and perhaps also into next year.
Javier, would you like to explain to our American audience why they shouldn't worry, they shouldn't fear, they shouldn't stockpile, because the chocolate here isn't really chocolate?
Oh, you really want to put me in trouble. I really, as with olive oil, I try to go to the high quality chocolate here in Europe.
Well, the high quality olive oil comes from one place, Javier. You know where that is. You and I can have a battle about that later. Javier Blas there, Bloomberg Opinion.
It's not Italy. It is not Italy.
Well, sorry, you're breaking up. Javier, okay. Sorry, sir. You're breaking up. It's good to catch up.
You know, he's not wrong, because a lot of the Italian oil is actually made with Spanish and
no, that's the fake
Portuguese
stuff. That's not the real stuff.
Portuguese.
I've had this debate with Javier already.
That's not the real stuff.
In wine, too, he has an issue.
But you've touched on a really important point. If it was Spanish, why wouldn't they label it Spanish? Why wouldn't they? Because
people think.
And because they think it is, it's worth
more.
Because
from Italy.
Because Italy's better.
Well,
so we'll leave that there. Hershey's,
okay.
I think the average Hershey's bar is 11% chocolate.
Okay.
I think it's 11% chocolate.
I get the dark.
So it's not
dark.
yeah, that's real
Super
chocolate.
Dark.
Yeah, you want sort of like a 70 plus.
Well, that's if you want like the health benefits.
You want actual chocolate.
You want chocolate.
Yes.
But like, you know, people like different things. I don't understand white chocolate though, because is white chocolate actually chocolate?
Kinda. More sugar, apparently.
But anyway, I will just say it's really unfortunate, and I think he's onto something with stockpiling. I know that you don't.
Are you going to stockpile too? Okay.
I think I'm going to start.
Look what you started on this programme.
It's on my list of words.
I know. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. S&P President Thomas Jordan is stepping down at the end of September. Jordan has been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis, removed the cap on the franc in 2015, and adopted the world's lowest interest rate. Don't miss our interview with Thomas Jordan later today. Dell is headed for the biggest gain in 6 months, up 24% after reporting fourth quarter results that beat expectations. Analysts say demand for AI servers is driving momentum. The stock has more than doubled over the past 12 months. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw support for its Facebook News tab in April. Publishers with existing agreements with the company will still be able to push content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for their content, but Meta says demand for the service has declined. That's your Bloomberg Brief. John.
Danny, thank you. Thank you very much. Up next on this programme, striking a delicate balance in corporate credit.
We feel like this start of the year is almost a repeat of last year. Some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens.
You know what confuses me? Reese's Pieces. That's what I just don't get them.
Because it's peanut butter.
It's just
with
like
coating.
That's what the companies are pushing out.
I just
all the gummies and
just
the peanut
don't get it.
I like
candies.
Reese's Pieces.
Just don't get it.
I'm not a big fan.
No, Reese's Puffs, the cereal.
You really like that, don't you?
That's my dessert.
Okay, that's odd. All right, from New York, this is Bloomberg. Equity futures on the S&P negative by 0.05%. In the bond market, yields lower by a single basis point. The 10-year 423.85. In foreign exchange, the euro positive by 0.1%. 108.18. Under surveillance this morning, striking a delicate balance in corporate credit.
We feel like this start of the year is almost a repeat of last year, right? We had a slew of kind of Goldilocks data, some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens. There's always something that happens.
There's always something that happens. Here's the latest. Enthusiasm remains in the credit market as spreads grind down to multi-year tights in the face of a record February for corporate debt issuance. Megan Robson of BNP Paribas writing this: expectations for 2024 are high, spreads are tight, and positioning is long. But the fundamental risk profile for credit has improved, with progress on refinancings and technicals continue to support spreads at these levels. Megan is with us around the table. So, Megan, talk to us why you think these themes can continue.
Well, thank you for having me, first of all. So I think what credit is really reflecting is downside risks are much lower. So if you're an investor, you're buying credit now because a lot of the risks that came into the year look better, and credit provides good carry. So, for example, the maturity wall and high yield, you've chipped away 40% of the expectations that of maturities we thought would have to be refied this year, and yields are at levels relative to October where refinancings are more of a speed bump rather than a roadblock, if you will.
Can you touch on those numbers again? How much of the supply that we have seen has just been pulled forward from what we expected this year, and how much of it was catch up from last year?
It's a great question. So let's look at IG. So February, we saw 200 billion of roughly 200 billion of issuance. And the headline number has to be taken with some caveats. About 25% of that was just 4 jumbo M&A deals. So the headline number is much more in line with historical averages when you take those out. And we've also seen a lot of the issuance is refinancing. So it's not necessarily a lot of new net supply that the market has to absorb, which somewhat explains why credit spreads have been able to maintain at tight levels.
What's the bigger risk for you? The investment grade side or the high yield side? The interest rate sensitivity or the sensitivity to a turn in the credit cycle?
So I think we still have a view broadly of decompression. So I think IG will maintain a very supportive technical backdrop. We still have yield buyers coming in at these levels. If we see yields back up, there's very much a buy the dip mentality in investment grade. High yield, I think, can hold in well here, assuming that rates stay at these levels and growth holds up okay. But if we do see any risk outside of the sort of baseline scenario, I would expect high yield to be much more vulnerable.
Which is the reason why I found it really interesting. We got some of the flows data overnight from the past week. And what we could see is people are still piling into bonds, but particularly investment grade U.S. treasuries. You can see those inflows, $13 billion into global stocks. You could see, $10 billion into or $3 billion into treasuries and $2 billion into investment grade. It was the first outflow, though, in U.S. high yield bonds going back 8 weeks. It was not that much, $0.7 billion with outflow. Does that mean something to you about a tide shifting?
So I do think it speaks a bit to just how much we've rallied in high yield. So we're getting close to 300 basis points in spreads. That's very tight. So at these levels, it would make sense to back up a bit. Our spread target for year end is 350 basis points. So I think investors who are buying credit for the spread or the risk premium are starting to think a little bit more two-way here. They're not just piling in, but you do see more buying and selling rather than just all in adding.
We'd love your view on the Federal Reserve as well. We just had a note from Torsten Slock over at Apollo. I'm sure you heard us talking about it. The Fed will not cut rates in 2024. The quote, the reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. Where are you and the team on that? What do you think of that?
Yeah, so we still have an expectation of 4 rate cuts this year. We think that the Fed will start in June and continue for the rest of the year. And I think for credit, that's going to provide a relief, and a lot of our leveraged finance issuers are expecting that. In particular, floating rate loan issuers will really need to see those cuts in order to get refinancings done and see some relief to their cash flow. I think the scenario Torsten has laid out would be particularly bearish for the loan market, where you have private equity sponsors and a lot of these issuers that are thinking like, I just need to make it 6 or 12 months, and then I'll have some release on the borrowing side.
That's exactly where I was going to go. Survive until 2025. Does that become we're diving in 2025? I mean, is that sort of this idea if we don't get those rate cuts?
I think that you'll see the maturity wall and the idea of interest coverage come back into risks probably third or fourth quarter if we don't see those rate cuts. So as I mentioned, maturities that have to be refied this year, we're almost halfway through those. But then looking at the end of this year, you're going to have the maturity wall step up again if rates aren't lower this could be coming back into the discussion.
It's a very catchy phrase. Could we just unpack it a little bit? Which companies are truly surviving until 2025? And does a 100 basis point cutting cycle of the Federal Reserve help a company that's on the precipice of failing survive?
So I think that it's not just the 100 basis points, but there's a confidence that the cutting cycle is underway. And if you're a private equity sponsor and you have cash on hand, you will have to pick and choose, and you're not going to infuse cash into every company that you own in order to help them survive. But there is this element of if the Fed cutting cycle is underway, and we could see 3 cuts this year, 4 cuts next year, then yes, I think that there is confidence that I will put this cash in the company because I can see it down the line being able to survive.
The mood has changed markedly in this market, as you know. Can you describe how the mood has changed with clients? Just what do the conversations sound like? Because in the equity market, we're trying to work out, are the pockets of exuberance? Have we taken things a little bit too far? How well received are these messages in your circles?
Clients seem very, very constructive. I think one way to see that more quantitatively is positioning. So we have a positioning indicator. It's in the 90th percentile. Positioning is very long. I think that the one place we haven't seen investors add is really the lower beta part of the market. So triple Cs, you're not seeing a wholesale buying of that, but look at single Bs in high yield credit, the second riskiest rating bucket, top performer over the last month. So I think it reflects this positive conviction for the rest of the year among investors.
It's been amazing to see this credit market over the last month, Bramo. Spreads super, super tight, tons of supply.
I'm just thinking about survive till 25. I mean, I really think that it's a good point because it really matters why the Fed is cutting rates. If the Fed is cutting rates because it's just sort of trying to keep this party going, then great, get it. Yep, go. But if it's because there's real damage, that means spreads are going to widen at the same time. It's going to create a very different type of scenario that doesn't exactly look like thriving in 25, but maybe, hobbling along still.
And not all rate cuts are created equally. Megan, it's good to see you.
Thank you so much for having me.
Thank you so much. Megan Robson there, BNP Paribas. Coming up on this programme, Michael Purvis of Tolbecken, Ellen Hughes Cromwick of Third Way, Lara Raim of FS Investments, and Chuck Grum of Gordon Haskett. Live from New York City, counting you down to the opening bell, about 94 minutes away. Equity futures are totally unchanged on the S&P 500. Yields are a little bit lower, down about a basis point. Crude's higher by 1.74%. WTI 79.63.
Rates market moving closer to where we think things should be, which is around 3 cuts.
There is certainly a lot of risk that the Fed waits a little bit longer. They're likely to err on the side of caution.
The big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
I think it's becoming increasingly likely that maybe we have no rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
And maybe we don't. And she's not alone. Live from New York City this morning. Good morning, good morning.
No.
For our audience worldwide, what's wrong with you?
I live for this. Let's get you to the weekend. Come on. Can we do that again?
What are you breaking up the show for?
Well, you did.
The camera's moved
Come on.
now. John, can you send the camera back? Can we do the move again?
Can we do it again?
Do you want to do it again? I can do it again.
I mean,
get the camera to go back in the room.
Yes, I think that we should. Let's get
John, can you send the camera back and I'll do it again?
Let's get you to the weekend. Can you say it?
I need the count in my ear.
Otherwise, you're not going to say it.
Thank you. Silence. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide.
Thank you.
This is Bloomberg Surveillance. Maybe I would have got there, Just let me complete a thought, Bramo.
There's no way you would have gotten there.
Jeez, you're on form today, aren't you?
I can't help myself.
Maybe we won't get any cuts, all right? I'll go through the note. Lisa Abramowicz, everyone. Annmarie Hordern, Jonathan Ferro, Torsten Slot. The Fed will not cut rates in 2024. The reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December.
Yeah, well, this is the issue. More people are coming around to this idea, albeit on the margins, but how much does that really kind of create a reality check to a market that's hitting new highs and where everyone seems to be shrugging off all their concerns?
I've never seen you so keen for the weekend in my life.
No, I think it's been an exhausting sort of whipsaw feeling of incremental moves and people just sort of grinding higher, not feeling too enthusiastic, but, kind of there's nowhere else to go.
Let's do this. Let's go here. Let's push ahead to next week. We'll talk about next Friday. Okay, let's look ahead to next week. weekend. Payrolls Friday. I'll give you a sneak peek at a survey. 190K is the median estimate in our survey so far. There's some moving target. We'll put together more of these estimates for you, and that number might move. But at the moment, 190,000 is the number. That's down from the blowout jobs report we had north of 300K in the previous month. If you look at unemployment, we've had unemployment south of 4% for 2 consecutive years. It's been phenomenal. We're still looking for that, Lisa, to stick at 3.7.
Here's the thing, and I think this is a reason why Torsten Slok is coming out and saying maybe we're going to get no rate cuts this year. If you come up with a theory, it might call for weakness. If you look at the reality, it ain't showing that. So then when do you start to say the reality is portraying a strength that we have to reflect in some of our forecasts?
That's the reality in the economy for the forecast around the labour market. Let's talk about the politics as well. So we're avoiding a near-term government shutdown. I'm not sure if we can avoid one entirely this year, but for now we can. Then we've got Super Tuesday with Nikki Haley's campaign just about holding on. And then AMH, the president, delivering the State of the Union about a week away.
Yep, delivering the State of the Union. It's a huge week for politics next week. What is he going to say in the State of the Union that pushes his campaign forward? We have reporting this morning that he's going to talk about tax cuts. My issue when the Democrats are talking about tax cuts is that they had a chance to roll back a lot of the Trump-era tax cuts early on of his administration, and they didn't do it. They weren't even able to close carried interest loophole. So what is he going to talk about? On the campaign trail, we have seen him, maybe he won't address in the State of the Union, we have seen him talk about raising the corporate tax rate, getting closer to the 28%. Also then, politicals reporting that, one of your favorites, Jonathan, he might address shrinkflation. So we're talking about the economy. The job market is doing well. This is something the president is going to tout, under 4% for 2 years. But inflation is still hurting them when it comes to consumers. And they're going to bring it up by saying, actually, it's the company's fault.
I can't wait for the Friday morning coverage of that speech on that very issue. Need to turn to the price action. Bit of a delayed start to this hour. I think we can cut out the beginning of it, can we, for the online version?
Well, you could have said, you could have started the right way.
Keep it. I did in the first hour. I said, let's get you to the weekend.
But you could say, heading into the 8 o'clock, it felt like, you know,
want me
how
to
do
do
we
it
get
again
there?
twice?
No, it's okay. All right, you're okay, carry on.
Can I proceed? Equities unchanged on the S&P 500. Are you turning into Tom? Is that what's happening here? Becoming so needy in the bond market. 425 on a 10-year at the moment. Coming up this hour, Tor Becken's Michael Purvis on why markets still have room to run. Ellen Hughes-Cronwick of Third Way on why EVs will be central to US economic leadership. And Laura Rame of FS Investments on why she sees interest rates normalising at higher levels. We begin with our top story this hour, kicking off March with stocks at all-time highs and strategists on Wall Street racing to upgrade targets. Tor Becken's Michael Purvis saying this: I'm quite constructive on both the economy and markets. I think seeing 5,500 on the S&P or even higher is a distinct possibility. Michael Purvis is with us around the table. Michael, good morning to you.
Good morning.
Goldman Sachs, 5,200. That's an upgrade. Piper Sandler, 5,250. That's also an upgrade. Barclays, 5,300, an upgrade. UBS in the last week, 5,400. You're saying 5,500 and beyond. What gets us there?
Well, you know, we had this condition, I think, really after the December FOMC, which I call sort of dual Goldilocks, which is that you've got the Fed stop talking about hikes. Now, I'm actually on Torsten Slok's page about very few cuts, maybe zero this year. But I would also argue that the Fed, the lack of hiking is really what's key here. And he has announced, sort of that big message of pivoting away from hiking to, if anything, the action is on the cutting side, right? So that's a very important thing from sort of the Wall Street side. Now, the dual Goldilocks condition means that concurrently, and this is really unusual by the standards of the last 12, 14 years, is that you have a worker consumer that's kind of in a Goldilocks condition as well. Not perfect, of course, it never is, but you have the worker consumer where real wages are climbing, where inflation broadly is falling, and you're starting to see nominal wage gains really come higher and higher and higher. So the concurrence of that, where you have a Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong, is really pretty remarkable.
Pause, Michael. You can imagine a world where we get to 5,500 beyond this year with no rate cuts in 2024?
I think that's I can, actually, right? I mean, I think what's really underscoring a lot of this is a shift, a very slow, subtle, but increasingly probable shift of going from what we knew before COVID of sort of very low, sort of the low inflation, low nominal world into something with a higher inflation floor, but also growth, right? And a higher nominal GDP outcome there where interest rates are going to adjust towards that, right? And so I think, look, I'm at 1 to 2 cuts this year. I'm not at Torsten Slok 0 cuts there. I think there's a very reasonable case for 0 cuts. But if the earnings are there, and let's not forget that you put up my quote about the Mag 7 will drive the rally here. Let's not forget that you're looking at 20% earnings growth year over year for the Mag 7 here, right? And even as inflated as those multiples are, if you look at the price earnings to growth ratio right now, it's around 1.1 for the Mag 7 there. That's a very attractive.
You keep saying 7, but you actually said 6.
Yeah, no, I know.
So who's dropped off this list?
Well, that would be, of course, Tesla, but it's also dropping them out is less consequential. But no, like of all those stocks to report, they had the one thing that was the sort of most problematic on earnings. They're also the smallest, and then they have a whole bunch of secular headwinds to face with the whole EV narrative sort of evolving as well. But those core 6 are the big ones, right? And those are the ones that are really driving the big tech story, but they're also really underscoring the broader S&P rally.
Which raises this question: do you need different leadership, or is it just going to be the same thing, which is Magnificent Six, I guess, basically driving this, even if rates go higher, and continued underperformance from the Russell 2000, from consumer cyclicals and other kinds of issues?
I think that the textbook tells you that, oh my God, the lack of breadth is a real vulnerability. I don't know if that really has to be the case, right? I mean, if these companies are able to generate the earnings that the street expects them to do, right? And they end up lifting up the other ones, as long as the other 490 odd stocks don't fall apart, right, on an earnings or fundamental basis there, and they basically hold together, right? I don't see why that really has to be problematic. It's weird, but I don't think it's necessarily problematic.
So what's the hedge? I mean, this is really the key question, because basically you're talking about the potential for no rate cuts and basically a sell-off in bonds potentially at a time where that used to be the haven. Where do you go now?
Well, if you want a market hedge, I would certainly advocate looking at VIX calls over S&P puts. I've been continue to be on that page for a whole host of reasons. If you're asking me about like, okay, well, duration is not as safe because of the sort of, what I look at as sort of a slower motion version of late last summer's backup in yields there. I think look, I mean, I think I don't want to say big tech is a safe haven there, but their business models are pretty strong and so forth. I think if you're a long-only manager, you have to think about that those earnings, even as inflated as the valuations are, you look at things like gold and so forth.
Bitcoin?
No, well, I won't, but you can.
But I'm just thinking, I'm listening to you talk, and I'm thinking, if you see big tech as the growth driver, you see big tech as the potential safe haven, why not just lever up, go all in, bet on them completely?
Well, I think I would probably refrain from doing that, right? I mean, I think the market is capable of just pushing these. It's been pushing these stocks for a while. What I'm saying, Lisa, effectively is that the valuations for the markets have gone through massive contortions over the last 4 years, right? With all the increase in rates and all that. I think the PE expansion or contraction story is kind of behind us. And right now, if there is earnings growth, those equities will go higher. And I do think you can expect earnings growth from the Magnificent Six to be reasonably strong this year. I have bigger questions about, say, the S&P equal weight.
Can I just finish on the auto sector? You dropped Tesla out of the Mag 7.
Sure.
How investable is the auto sector in America right now?
Well, look, I'm not an expert on the auto sector, John, but I would certainly say this, that I think there are massive questions about whether EV is going to stick, and I'd say it's whether the price, whether the pricing can adjust and the business models can adjust to that. I think it's definitely a brainer. I think it's pretty tricky.
Yeah, big time. Michael, thank you. Michael Purvis of Tallback and Capital Advisors. We'll be talking with an expert in just a moment. I do love Wall Street. I'm not an expert, but you've always got an opinion, Michael. Come on. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. S&B President Thomas Jordan is stepping down at the end of September. Jordan has been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis, removed the cap on the franc in 2015, and adopted the world's lowest interest rate. Oh, and also handled the collapse of Credit Suisse. Don't miss Bloomberg's interview with Thomas Jordan. That will be later today. President Biden plans to increase taxes on corporations and the wealthy and lower prescription drugs, and he'll address all of that in the State of the Union next week. Biden plans to lay out his economic agenda for a potential second term in office, trying to convince voters that his administration's efforts warrant another term. The State of the Union address takes place on Thursday evening. Treasury Secretary Janet Yellen says any plans to seize Russian assets cannot be seen as a replacement for aid to Ukraine. Ukrainian aid has been a key issue that's been held up in Congress, now in the third year of a war with Russia. In an interview with Bloomberg, Yellen said that the EU has offered Ukraine, quote, very meaningful finance, but the total just doesn't seem like enough. That's your Bloomberg Brief, John.
Danny, thank you. Bramo, we're going to take a break now, all right? Just going to go to the commercial break, take 3 minutes out. You know how this works. Up next, you ready?
Go for it.
The US cracking down on Chinese EVs.
You'll have Tesla competing with like the best Chinese players, BYD, and it's going to be very hard to make a living outside of these two poles in the industry.
Let's get you to the weekend.
Yes.
There you go. I'll just repeat it for the rest of this hour. I've never seen you like this. From New York, this is Bloomberg.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
It's a quiet start to Friday morning, going into the weekend totally unchanged on equity futures on the S&P 500, going almost absolutely nowhere. Yield to higher by a single basis point on the 10-year, 426.60. Under surveillance this morning, the US cracking down on Chinese EVs.
Tesla has been doing an extremely good job, has pushed like the bar very high, and now the Chinese are coming in, filling the void around Tesla, and the competitive gain between Tesla and the Chinese is not going to leave much room for others to be successful. You'll have Tesla competing with like the best Chinese players, BYD, and it's going to be very hard to make a living outside of these two poles in the industry.
Here's the latest this morning. The White House ordering a probe into potential data and cybersecurity risks posed by Chinese EVs. President Biden issuing a statement saying this: China's policies could flood our market with its vehicles, posing risks. I'm announcing unprecedented actions to ensure that cars on US roads from countries of concern like China do not undermine our national security. Joining us to discuss is Ellen Cromwick-Hughes of Third Way. She's also the former chief economist for Ford and the US Department of Commerce. Ellen, it's wonderful to catch up with you. I have a first question, an obvious one. If Chinese vehicles are going to pose a national security risk, what are the chances that maybe they're just banned?
Well, we did hear from Secretary Raimondo this week following the statement from President Biden. And basically she said, look, we're going to look at everything. We have to study this. We have to make sure that we protect and our national security is not at risk. So they're looking at everything. I mean, she said all the way from banning to ensuring that the tech in the EV is American made or made by one of our trading partners. So they're going to look at everything. They do great studies at the Department of Commerce, as you know, and I think it's worthwhile. I mean, we have to make sure that we protect and we have national security, freedom, and capitalism at the top of our list.
Ellen, do you think this is more a matter of national security or preserving jobs in Detroit?
I think it is first and foremost national security. As you know, we've seen over the last couple of years instances where our national security has been compromised. And we know that we have to make sure in the future that we protect and defend. And that's absolutely critical. Now, the U.S. manufacturers, Ford, GM, Stellantis, a lot of our other manufacturers, they're not shying away from competitiveness. Nobody wants to have a protected market that means that basically we end up weakening our product creation over time. We need competition to make sure that that we have ongoing innovation. And innovation, as you know, is key in the electric vehicle market. There's been a lot of it, but there's more coming.
Well, Ellen, and the source of that innovation has been in China. The source of that innovation and bringing down the costs are really in BYD and the likes that we've seen coming out of the world's second biggest economy. Don't you think that it would essentially hamper the trajectory to a more electric vehicle-friendly future to ban Chinese vehicles from being sold to the U.S. and bringing down that price point aggressively?
Well, Lisa, let's step back for a minute. Look at VW. Look at Ford, their initial first-generation electric vehicles. GM, they're making progress. They've made commitments. Tesla. We've also seen incredible product now coming out of Hyundai Kia. So let's stand back and say it's not just China. Now, let's look at China. They have been subsidizing their electric vehicle industry for 2 decades now. I mean, I remember at Ford when they started the subsidy programs, and they invited U.S. leaders, manufacturers like Ford and GM, to China to help them with product development, modeling, forecasting, innovative product creation. So it's not like it happened in China without a lot of support. So now what do? We have to get competitive. Look, this industry is going to electric vehicles. I know you've heard from guests that are wobbling on this, but we did a study on competitiveness. If you go to Third Way, When America Leads, basically you've got $27 trillion of addressable market between now and 2050 as we transition to EVs. So it's not a question of if, it's just when. Infrastructure and product development and rolling out an emerging technology, all of that takes some time. It's not like it's going to happen in a quarterly earnings report.
Ellen, we have Giorgia Meloni, the Italian leader, visiting the White House today, and Italy is said to be asking BYD to potentially come set up shop and be another manufacturer in Italy, while at the same time the U.S. is thinking of completely banning potentially EVs. I thought this administration always wanted to take a multilateral approach when it comes to China. Doesn't this administration potentially need to shore up where the Europeans are as well when it comes to Chinese EVs?
Super good question. And, you know, Italy used to have an automotive industry. And, so I can understand why they want cheap vehicles coming into their market to satisfy where they are in terms of their economic growth and prospects. But here in the U.S., we have already developed the beginnings of an electric vehicle market. And listen, have at it. You know, if we find that BYD, ends up with no national security risks, come into the market. I don't think anybody is shying away from competing, but we need to make sure we understand that market in China has been subsidized for many years. But we're not going to lose in terms of our automotive market. Look, we've got 4 million jobs in the automotive industry, and then a job multiplier of about 10, where those paychecks of workers are being spent in local communities on businesses, retail businesses, and all different types of, consumption. So, it's not like our auto industry is going to go away. It's absolutely core to our U.S. economy. And that's why EV policy is really working. In fact, there's a study that was done on clean energy investment, cleaninvestmentmonitor.org, if anybody's interested. In the fourth quarter of this year, there was $12 billion. That's inflation adjusted at a quarterly rate, in terms of investment in the EV supply chain, critical minerals, batteries, vehicle assembly, and charging equipment. So there's been a lot of investment growth in the EV supply chain just in the last year. And we're only starting because a lot of these programs last for about 10 years.
And I just have to say only one piece of pushback. You can't say Italy used to have an auto manufacturing industry. There are 5,000 employees in Maranello who will be deeply unhappy. Ferrari, Ellen Ferrari, come on. Ellen, thank you. It's good to see you. Ellen Hughes-Conwick there.
Good catch.
A third way. Ellen, thank you. Got to offend half of Italy here.
You're like an Italian.
A whole region.
You're the ambassador.
You've got to police the conversation a little bit. Like I could carry on listing anyway. All right. Coming up very shortly, Laura Rame of FS Investments on why investors should reframe their interest rate outlook. We'll be talking about that, particularly after Torsten Slok of Apollo came out with that big note a little bit earlier this morning, basically making the point that he does not think this Federal Reserve will cut at all this year. We're going to catch up with him on Monday at 7:30 Eastern Time. So get that one on the calendar.
Basically, good news is good news. Treat it on its face. But it's going to be bad news for the Fed rate cuts. And that's seriously what a lot of people are thinking about. But we just heard from Michael Purvis, it doesn't matter. We can still get to 55.
And Jerome Powell is on the Hill next week. So this is going to be the first question. What is the timeline for these rate cuts? Because remember, he went out and talked to 60 Minutes, basically saying, I think shoring up the American public in a political election year, why he had to go down this path.
You know how this works, though, down in Washington, D.C. You turn up and ultimately you say the same thing you said in the last news conference. Maybe you inject something new, something fresh if you want to, and he can. He has the opportunity to do that. But it's always the lawmaker making a clip to make a commercial to speak to his constituents or her constituents.
You're just as exasperated as I am.
I hate it. It drives me nuts.
The rooms are empty.
They practiced in the mirror.
Of course. It's all a shtick.
The Italians are writing in. People at Ferrari would also be insulted if you referred to their product as merely autos. Well said. Art. Equity futures on the S&P 500 unchanged on the S&P. On the Nasdaq, positive by 0.1% on the Nasdaq 100. A little bit of a lift here as we close out the trading week. In the bond market, yields look like this: 2-year, 10-year, 30-year, 2-year higher by around about a basis point. On a 10-year, up by 2 basis points to 4.27. Lisa, a little bit of a lift today, but yesterday clearly moving in one direction off the back of an inline PCE report.
And I think you made a great point. Is inline the new beat? That we're now just looking for boogeymans under the covers. And if we don't get them, well, then all systems go rally. But, here's the question. How many people are going to come around to Torsten Slok's view of the world? No rate cuts this year if the economic data keeps being this strong.
Stay tuned for Laura Rame of FS Investments, who believes maybe we are normalizing to a much higher rate profile in this market. That's worthy of conversation. Let's finish on the euro. The euro against the dollar at the moment, positive by 0.06%, 108.11 on that currency pair. A little bit earlier on this morning, we had some Eurozone inflation data. Wrong kind of upside surprise on CPI. Bramo, just pushing back the timeline again of that conversation. The need for urgent rate cuts in Europe with a growth profile that probably needs it. If they didn't have this inflation story, rates wouldn't be here. Let's put it that way.
So consumer prices rose 2.6% from a year ago in February in Europe. That compares to a 2.5% median estimate. It's where the price pressure came from, in my view. It comes from the services side. Again, this isn't coming from sort of the more fluctuating kinds of commodities and goods. This is really sticky services.
If you're getting excited for action, there was all this talk about a March rate cut from maybe the ECB, maybe from the Federal Reserve. This was a conversation that's only about 2 months old, and maybe a BOJ rate hike. And based on what we heard from Governor Ueda, doesn't sound like that's a man who's going to hike anytime soon. I will caveat that with this. It wouldn't be the first time the BOJ has just come out and changed its mind at the meeting, or at least just done whatever it wants without feeling the need to communicate it in quite the same way as, say, Chairman Powell or President Lagarde.
Is it on your list of potential
worries?
Surprises? Yeah.
I don't have a list, which is maybe the difference between you and I.
Maybe that's exactly
you have a list
problem.
and I just don't have one.
Well, this is the reason why you haven't seen much action in that currency pair, because nobody's willing to really get on that list and really say that's the big one.
True. 108 on the euro, about 150 on dollar yen. You're on form today. Under surveillance this morning, President Biden and Donald Trump clashing in dueling visits to the US-Mexico border.
This is a Joe Biden invasion. This is a Biden invasion. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
Biden and Trump 300 miles apart, each seeking to highlight their ability to respond to a migrant surge that's become a hot-button issue ahead of November's election. AMH, 300 miles apart physically, just in terms of the rhetoric, how many miles apart were we?
Rhetoric, miles apart. But if Biden does take that move and does an executive order, he'd be using the same law that Trump relied on. So when it comes to the policy, Biden is now coming out and also saying we need to do more on the border. The Republicans have pushed him there. It's a very different Joe Biden than we saw leading up to the 2020 election. Jill Biden was writing in opinion pieces about how they wanted to make sure they restored the asylum protections. They talked about bringing more humanity to the border. This is a huge problem, though, for Democrats, because polls show, Gallup this week, it's the #1 concern.
What did Obama do differently? A lot of people are talking about this as Obama as deporter-in-chief. What did he do differently that Biden isn't doing?
Part of the criticism Biden is getting is that when he came into office, he basically said, we are not going to take the same approach that Trump did. There's not going to be a Remain in Mexico. We are going to bring more humanity to this. And what people say is that was just this shot heard around the world, basically, for individuals to say it is easier now to get into the United States, and that's what we're going to do.
Okay, I just have to say, though, if you take a look at the new Trump 2.0, what he's proposing camps to basically arrest all of the immigrants, the illegal immigrants here, and then have active deportation. So it's a slightly different Trump also than the previous Trump presidency. So there is some daylight in terms of just what those measures would look like.
Waiting to see what the actual policy will be from the current administration. This president. I want to turn to a single name. Big move earlier on today. We had a move of about 30% on NYCB. Since trimmed those losses, the stock is down by a little more than 22%. The bank and the shares absolutely plunging after the commercial real estate lender said it found, quote, material weakness in how it tracks loan risks. The bank saying in a regulatory filing that the issues stem from ineffective oversight, risk assessment and monitoring activities. None of that, Bramo, sounds good.
No, and that's the reason why you're seeing the shares fall further after already falling completely out of bed. We've been talking about the idiosyncrasy of this particular name tied to rent control issues in New York and just very specific real estate. That said, if we take the Torsten Slok view of the world, how does that reprice real estate in a more material way that hasn't been fully appreciated in some of the risk models, particularly at regional banks?
In the last 24 hours, twice, we have heard two credit guests say survive until 2025. What if you get no rate cuts in 2024? Why does it leave that cohort of very leveraged borrowers that are looking to finance and maybe can't get it?
Especially if you're talking about higher rates because of the strength of the Magnificent Six or Five or whatever you want to call it, not necessarily because of overall economic strength. In other words, there are still companies that are going to fall out of bed with higher credit risk, even with the overall general rosy glasses.
Let's talk about interest rates and central bank policy. New York Fed President John Williams reiterating he doesn't see rate cuts coming anytime soon.
Eventually, I do expect us to cut interest rates later this year. I think that makes sense with inflation coming down and the economy being in better balance. We're going to move interest rates back to more normal levels. But really, right now, there's not a sense of urgency to do that.
Bostic, Waller, Logan, Daly, Kugler. To sort of round out the week here, we've had so much Fed speak this week, Bramo. No big changes, I have to say. No big changes at all.
I want to make a placemat. I think that would be really fun with
what,
all
for
of
the kids?
Fed. Yeah, and make all of the Fed heads from a particular week of speakers, and then make them run it out.
Not much has changed, and I think that's what's interesting here. Not much has changed for them. They haven't had to change their views in quite the same way this market has had to over the last 2 months.
They had 3 rate cuts this year. They've watched the market roller coaster and then come back to them. Is the balance of risk so shifting in a different way? And we talk about the potential for more rate hikes. I don't think that people are really giving that real thought. The idea of no rate cuts, though, that's what I want to hear them play with around the edges.
I've been looking forward to this conversation so we can play with that story right now around the edges. Lara Raim, chief economist at FS Investments, weighing in on the rate cut debate, saying this: I want to convince investors to rethink what higher interest rates can mean for investment returns. Core to my outlook is the expectation that interest rates are renormalizing at a higher level, an outlook that investors often interpret as a challenge, but I argue it should be reframed as positive. Lara, I'm pleased to say, joins us now for more. Lara, let's go straight to Apollo, to Torsten Slok, just around the corner from here. They're saying no cuts for 2024. I know you're not there in quite the same way, but the forces that lead you to believe that maybe we are renormalizing at a higher level, Lara, what are they? And do you share some of those views that Torsten has?
I do. And I think we need to always be mindful of the fact that while the Fed may signal they want to change policy, markets, the economy, inflation, it may not clear the path to the rate cuts that they are hoping for. At the end of the day, we are seeing no urgency on the economic side to cut rates. And I think we need to start to get a little more nuanced with the real rate story, because I think the Fed could surgically cut once or twice to just keep policy at the stance that it is. Markets may interpret that as accommodative, but we need to be really careful to push back against this idea that we somehow need rate cuts. I think we're doing just fine without them.
Laura, what's changed in the economy to support your thesis? What has changed over the last 4 or 5 years? It's a conversation we had with Callum Pickering of Berenberg earlier on this morning. He described maybe the last 5 years. He said if you take out the two big supply shocks, the war, the pandemic, he said we were already on a trend of higher neutral rates over the next 5 years anyway. Lara, do you share that view as well? What is leading to that? What's underpinning that?
I do. And I'm a big believer in the long run, great moderation that we experienced since the financial crisis. This business cycle being blunted by massive amounts of Fed intervention in interest rates. I think that period ended. We saw the beginning of that with the early trade wars under the first Trump administration. And I think it really catalyzed a more volatile cycle of investment. Remember, the Fed finally was able to raise rates, before the pandemic. And I think this has all been sort of an unwinding of that really artificial volatility suppression that we saw with massive amounts of quantitative easing. Now, the process has sped up. And I think from here, we're out of the world where inflation stays in that 2% lane. I think, a lot of people would argue that the difference between 2% and 2.5% and 3%, it's sort of quibbling with a smaller difference. But the reality is, from a policy perspective, if you can't rely on inflation being low, you really need to be much more proactive. And that's a very different world than we've had. And let's face it, the momentum, the growth momentum, the investment that we're seeing, these are really positive, innovations. I think that's what I want to leave everyone with. When I say that interest rates are normalizing at a higher rate, I get a lot of pushback that I'm being very pessimistic. This is a great opportunity for investors that we haven't seen in decades.
Yeah, you talk about where exactly you see that opportunity, particularly in credit, high yield, leveraged loans, and private credit. I want to just sit on why we're seeing people suddenly rethink this idea of rate cuts this year in scope and size. Do you think that the fact that we did see greater accommodation in markets, there was an easing in financial conditions on the heels of Jay Powell's discussion at the end of last year, that has helped inflation stay hotter for longer, that has actually made it difficult for the Federal Reserve to cut rates this year?
I do think so. And I think, listen, there's a behavioral component to this too. Markets for 15 years have been used to rates being so low. They've gotten used to that sort of idea that that's normal. And when we look ahead, we're in a world now where if higher, the yield curve is still inverted, we need that to normalize, especially in a backdrop where we're not going to get some sort of severe recession. So I think markets really were relying on recent memory. If the slightest opportunity, the Fed slams rates back down. We're just not in that world anymore. You go back to the 90s, even the early 2000s, we had a lot of episodes where rates were sort of in a more normally sloped way. I think that the banking system would be thrilled to have a normally sloping yield curve again, which would happen with a combination of some rate cuts, but also higher, longer term interest rates drifting higher.
That's where I was going to go. This idea that maybe the most expensive area, or perhaps overpriced area right now in the market, that some have suggested, Katie Kaminsky among them, is, say, 10-year treasuries, where you aren't pricing in this higher for longer type of scenario. How high do you think rates could go on the long end? Could 10-year yields go before it does become punitive and restrictive in a way that becomes self-correcting?
I think we're going to visit 5% again this year. And I think we need to think about the fact that, to me, it was really the speed at which rates moved that made 5% feel so punitive. Liz, without zero interest rates, you're going to see some companies that were artificially held afloat by this suppressed interest rate environment really, I think, come under distress. But I think there's a rich investment environment. There's a ton of private credit out there. These refinancings will get done. There's going to be a price adjustment. But I really think this opens up a ton of opportunity for investors. We're out of that, Tina world where there's no alternative. We're really now in a place where there is a lot of options for investors and alternatives that give you double-digit returns outside of equities.
Yeah, only a few years ago, this yield was unthinkable on a 10-year, but here we are, back to where we used to be in the good old days. Lara, thank you. Lara Raim of FS Investments. That 10-year at the moment, by the way, 427. Lara and the team think maybe we can retest 5%, Bramo, all over again. Not at the front end. We're talking about the longer end as well.
That's a theme this week. We've heard more and more guests say that the biggest mispricing right now is at the long end, not the short end, because that's been fluctuating in response to these surgical cuts. But the idea that this is an economy that's a lot hotter than what people previously thought, and that rates can afford to be a lot higher for a lot longer, I don't think we've really grappled with that.
A week today, we'll have a new payrolls report in hand. It'll be about 13 minutes old. Let's talk about it then. If that data doubles down on what we heard at the start of the year, then you've got to move. Because then it's difficult to dismiss it just as 1 month data, let's move on. You double up on that in February, then we've got a bit of a trend, haven't we?
And then all of a sudden you start to get questions about the fiscal spending and deficit, and all of a sudden you get one bad auction, and all of a sudden, yes, shoot up to 5%.
Run. Don't buy. I love how markets work, isn't it great?
It's true.
Equities right now unchanged on the S&P 500. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of B. Riley are down in the pre-market about 11.5%. The boutique investment bank is delaying its annual report. B. Riley says its board and outside counsel are reviewing its dealings with Brian Kahn, the former head of Franchise Group. Now, it didn't give a firm estimate of when it will file the report, but in it doesn't expect any significant changes to financial results. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw its support for Facebook News tabs in countries from April. Publishers with existing agreements with the company will still be able to post content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for their content, but Meta says demand for the service has declined. Elon Musk is suing OpenAI and its CEO Sam Altman, alleging that they have breached the AI startup's founding agreement by putting profit ahead of benefiting humanity. The 52-year-old billionaire says the company's close relationship with Microsoft and the makeup of its new board undermines its original mission of creating open source technology that wouldn't be subject to corporate priorities. Musk was one of the early funders of OpenAI. And that's your Bloomberg Brief. John.
Danny, thank you. I mean, he's kind of got a point with the Microsoft thing, right? I mean, like, not legally, just saying, sort of conceptually, once Microsoft makes an investment, it's not a charity donation, is it?
Well, okay, but how much of this is him just saying, you've gone on the wrong bandwagon and it's not fair for us, versus intellectual freedom and
sure,
let's all get everyone together and kumbaya with coding, and this is just why they get to.
Gets the conversation going. Up next on this program, the US consumer continues to surprise.
Throughout 2023 and into 2024, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit.
That's coming up next on the program, live from New York City. This is Bloomberg Surveillance. Let's check out Apple in the pre-market going into the opening bell. A bit softer through much of this morning. At the moment, negative by 0.6%. Not a major move. So Apple removed from the conviction buy list over at Goldman. Do want to point out, though, still reiterating their buy. The analyst pointing out it's still a buy. The price target's 232. It was 223. They say this, Bramo: Apple's installed base growth, secular growth in services and new product innovation more than offsets cyclical headwinds to product revenue. So still constructive overall.
Basically, we've seen that smartphone recession, and it's sort of coming back, but we heard that even from Cristiano Amon, that, they're sort of in a stability point, not necessarily the growth point yet. How do you then grow profits?
The stock just a little bit lower. We're down by 0.6%. Under surveillance this morning, the US consumer continues to surprise.
Throughout 2023 and into 2024, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit. Once they find us, they're very value focused. And so, the percentage of our tickets that are taking advantage of our LTOs, our limited time offers, and our value portion of our menus are up a few ticks from where it was before.
Here's the latest today. Target, Kroger, Gap, among many retailers set to report earnings next week. Chuck Grom of Gordon Haskett expecting shopping to pick up, saying this: the combination of positive real wage growth and improving inflation should become a source for consumers to shift back to goods as services plateau. Chuck joins us now for more. Chuck, can you identify the kind of companies then, based on that theme, that you like and think maybe are underappreciated? No audio. He's on mute. We'll sort that out, Chuck, if you can sort that out, if you can hear me. You're back, you're with us? Good. Chuck, you heard the question. You can carry on answering it.
Yeah, sorry about that. So I think it's important to look back, right? If you look back in the holiday period, what we've heard from a couple of retailers, Walmart and Costco, is that we're beginning to see signs of some units starting to pick up in some of those discretionary categories. So when we look forward over the next several quarters, we think that we're going to continue to see that across retail. And I think companies that we think are poised to benefit would be Target in particular. We think Target's mix of general merchandise is much higher than most of their peers. Their general merchandise business has been under a lot of stress over the past few quarters, or really over the past year and a half. So it's really Target's the one we think could benefit from that trend. And we upgraded the stock about a month ago.
Chuck, going to goods, away from services, why are services plateauing? What's happening there?
Well, I think we're starting to see signs. If you look at PCE data yesterday, you're starting to see services as a percentage of total PCE start to balance out. And we think goods could start to recover. And it's really predicated on inflation. What we're seeing in food prices start to compress. We think real wage growth is accelerating. So it's a little bit of a bet, but we think it could happen.
One thing I've noticed, Chuck, is that there's been sort of a shift just subtly under the hood in the narrative with respect to this divide between higher income and lower income families and their spending. And we've heard from several guests this week that actually there isn't that much of a divide and that there seems to be renewed appetite among lower and middle income houses to spend as well. Do you see that same trend? Do you expect that to come through in some of these earnings?
Yeah, that's a great point. I think if you look at the pressure that the low end sees over the past couple of years because of higher energy prices, because of higher gas prices, higher food, it's really condensed to that low income customer. And as we look forward, that lower income customer is going to start to get a benefit. And we think we actually could start to see it in the month of March. If you recall, a year ago, tax refunds were really low. That really hurt the low end customer. When food prices skyrocket, that hurts the low end customer. So we think the low end companies like Dollar General, Dollar Tree, we think Walmart could benefit too. You see the off price guys. TJX had great results a couple of days ago. So yeah, we do believe in that trend.
There's also a question of how much this is being fueled on leverage in terms of credit card receivables continuing to climb. We are seeing more defaults and delinquencies. Do you think that that's a head fake because ultimately it's coming off the lowest levels in 30 years and people have actually deleveraged? Or do you think this is something that really is a warning sign?
No, I don't. I mean, it's a yellow flag. I would deem not a red flag. If you look at household debt as a percentage of disposable income, it's still really low relative to historical levels. So this isn't 2008. I do think credit is increasing to a degree, but this isn't a terrible situation. I don't think at this point in time.
Bloomberg Intelligence, though, says the amount of retail bonds facing negative rating action surged to $69 billion in February. Well above the $46 billion in February a year ago. At what point do you start to get concerned then?
We'll continue to monitor, the credit data that we see, and we'll also look at the delinquencies for the retailers that we cover that actually have credit card businesses, Macy's, Kohl's, Target, Lowe's to a degree. And right now, their credit trends are deteriorating. But again, it's not a red flag in our opinion at this point in time.
Chuck, can we talk about those consumer delinquencies that have picked up more recently? We hear so many competing theories on this. Some people have pointed out that, like you have, that real incomes are increasing, so the consumer's looking pretty decent. They have space to lever up here. Other people pointing out there's clear deterioration. Which one is it?
I think we'll continue to study the data over the next several quarters and see how the consumer reacts. Our view is that as we move through the spring, we think that spending will begin to accelerate. And we think that's a trend that, again, going back to the holiday period and what we heard from Walmart and Costco, we could start to see. But like everything, we're going to continue to study the data. And I think it's important to keep in mind, when unemployment is at the lowest levels since the 1950s, the consumer can spend, but they're also being very discerning where they're spending. You talked earlier on your guest on value, and value is in vogue. You'll see consumers spend spend at Costco a private branded product, but they'll also spend a big ticket item. So they're just being very discerning right now.
Dime Brand CEO saying exactly the same thing. Chuck, good to hear from you.
Yep.
Chuck Grom there of Gordon Haskett. Looking forward to the numbers coming next week. Speaking of next week, on Monday, here's the lineup for you. Laurie Cavacina of RBC Capital Markets, Jane Foley of Rabobank, Nuria Rabini of Macro Associates, and Torsten Slok of Apollo. Torsten Slok got a lot to answer for with that call. No rate cuts in 2024. We'll see where we are, Bramo, a week today.
I cannot wait to talk to him. I also can't wait to talk to Nuria Rabini because I want to see his lists of worries.
Oh, I bet you can't.
And basically,
he's got a book of them, Bramo.
He's got so many of them.
And how many do you two line up on?
We line up on a lot of them, but both of us sort of tend toward the catastrophic. But I am curious about how much that list has really gotten shrunk, given some of the positivity.
At the very back of that book, if you look, it says a thanks to me and TK. So I don't know how much we influence that thinking over the years.
It's a natural sort of, safe kind of default to just kind of have catastrophic thinking.
Yeah, I mean, for me, next week, it's less on the catastrophic thinking of Lisa, but more of the information we're going to find out of Washington. Jay Powell, President Biden, and more than a dozen states go to the polls for Super Tuesday.
There's a lot on deck. You know what happens next? What's tomorrow, Bramo?
Tomorrow's Saturday. It's the weekend.
Let's get you to the weekend.
Have a great one.
Like from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.